And that's, again, like I said, this is also why we're recording these, so that you guys later on can review them, but so that other people can review them too. All right. And please tell me that you guys can see it. Sheila, you can see it okay?
Once again,
Yes.
I'm not seeing the screen that you've got up. And I don't know what's going on with my Zoom.
It's not coming up because can everybody else see it?
Oh, now I see it. I see it now.
I can see it.
Okay, cool. All right, we just wanted to make sure. I didn't want anybody to miss it, because the idea is for you guys to learn it. That's the biggest thing that we're trying to do.
It took a while.
All right. I gotta get that coffee. If you don't get the coffee in place, whole day's ruined. Okay. By the way, that's one of my goals. See that sitting there drinking coffee in the suit? I don't do the suit as well, okay, but with paper, just enjoying it. And my papers are usually digital, but that's how I want to spend my mornings. Okay. So what we're going to cover today, for the first part, and then for the second, we're going to take a little break in the middle, because I like doing a little bit of a break, because if I don't, I know that you guys are going to suffer from brain fry. All right. I know James has a tendency to say, well, let's work right through this. Okay. I know you guys end up with brain fry after a while. I've taught way too many classes to know that people can go straight through. So I'll take a little bit. What we're going to do today is we're going to do I'm calling them the less used business types, because they're a little bit different than the major ones. They're kind of just takes on the major ones. And then we're going to go into the actual business accounting, like accounting methods, accounting periods, and we're going to start getting into an income statement and a balance sheet. Okay. All right. So let's get going here. The less used ones are pretty simple. All right. There aren't too many of them. There's 5 little ones. Can we remember what the big ones are? If we think about it, what are the big ones?
LLC.
No, not an LLC. No. What are the big?
S Corp, C Corp.
There you go. 2 of them. S Corp, C Corp. And there's only 2 other ones. They're the easy ones.
Partnership.
Partnership.
And sole prop.
Oh, look at that. Did you hear that, guys? Did you hear that, woman? That was 4 out of 4. That was awesome. Sheila, that was great.
Thank you.
4 out of 4. Way to go, Sheila. 4 out of 4. 4 major ones. Sole proprietorship, me. Partnership, me and my friend. Corporation is the C Corp, which is, I don't want the liability, so I'll stick it all over here. Problem, it gets taxed and I get taxed. Don't like that. I don't like paying taxes twice. So you get the 4th one, an S Corp, which is a pass-through. Okay, so that's the 4th major one. Now it works kind of like a business, but you have a little less shielding, but it passes through to me, the taxation. And I get the benefit of not having to pay taxes twice, right? So that's the 4 major ones. Now remember how it works. C Corp, greatest amount of shielding, least amount of liability, but double taxed, tax issues. S Corp, little more liability because things pass through to you, but you don't get double taxed on it. So I've got a little more liability, so the shielding's a little bit less. Then you come down here to a partnership. Now it's starting to get to where it's my share is kind of my liability. It's coming through here a little bit, that sort of thing. And it's got a few more restrictions, like who the partners, how much of a share they owe, how it transfers, that sort of thing. Then you've got a sole proprietorship. I got everything is under my control. That's great. I get all the tax benefits, but I also have all the liability. No shielding at all. It's all me, and it's just me. Okay, so that's how you go down this way. Greatest liability, and greatest amount of income, up to the shielding, least amount of liability, but double taxation. The income kind of, you pay for it. All right, and that's how you look at it. That's the scale. So off of these, there are about 5 little subgroups, okay? That there are some things that were created so that these 4 have 5 little groups down here that were created for some specialty groups, okay? These are the general ones. These 5 are the ones for little special groups that had special needs, okay? And what they are is basically if you're a married couple, husband and wife, they're a special consideration. A husband and wife already have that joint tax return. They already have their everything is in both names, so they really already have a partnership. So that passes on to them. You have an LLC. Remember, it's a corporation, but you have limited liability to the people, but it wants some benefits and some restrictions. And again, like I said, we're going to go into those. The other one's an LLP. So you have partners, and it's typically like a law firm. Okay, I'm running under this business, but I want to run my own business. Okay, so I want to run. Here I am, and I'm an attorney, and Bob's an attorney. We have a partnership. All right, but if I do something wrong, I'm at risk, and Bob is not. I have limited liability partnership. Okay, and we'll go into that in some detail. Then we have personal service corporations. These are specialty groups, and there's actually a list of the groups that fall into it. These are a special group that are only doing certain tasks. Performing arts is one of them. And they can only be, and they have to declare it, and they have to set it up the right way. They are taxed at a flat rate of 35%. They don't have to do a lot of stuff for their taxes and all, but that's just it. They get taxed 35%. Okay. Then finally, it's farmers and fishermen. And we kind of heard what that was, is big business. They are a business. They're growing stuff. They have certain things that they're doing. They had to have special consideration because of the nature of their business and because of the extreme fluctuations. They had to have special considerations from Congress so that they didn't get hit with losses when things happened. Okay, so they created a special group for just them. All right, so now let's get into them a little bit. All right, married couples. My wife and I, Lisa, you were just doing crafts. Do you do that with your husband? Does he help you with that, or is there anybody?
He helps me. He helps me in the area where he goes to the festivals with me and does the sales.
Okay, so yeah, so you kind of do have your partnership with your husband. Okay, I do lots of stuff with my wife in regards to it. She hands something to me and says, I need to have this way, and I do it, and then I hand it back to her and make the changes she needs, that sort of thing. And then we'll go to where she does them. It's usually church sales, Christmas bazaars, things like that we go, and we usually do it and give the money to the church or whatever, but that's how we handle it. She also does some accounting on the side that I help her with. Usually what ends up happening is it works to be that she'll do the paperwork, I do all the interaction with the client, because she just prefers it that way. She would rather she handles all the paperwork, I handle all the interaction with the client and just talk to them and set it all up and make sure everything's in place, that sort of thing. So now what happens with it is basically considered a partnership. Okay, you don't have to have the formal agreement with it. It's just kind of your formal agreement is your marriage. They both have to materially participate. In other words, it's not like the husband is just sitting on the couch and the wife's doing everything and running the business and all, and the husband is not a partner. Okay, at that point, he has to actually, both members have to materially participate. So they have to both be in it, and that is considered without paperwork, it's a partnership. Okay, and this allows for each spouse to take the credit for the self-employment earnings from the business and the Social Security issues that they have. All right, and the items of the business, the income, the gain, the loss, the credits, they are split between the spouses. Now, if one is more so than the other, now again, this is a partnership. All right, so it does not have to be split 50-50. It could be 25-75, and it's entirely up to the spouses. All right, so it actually does get treated as two individuals, as partners, and it gets reported then on their Schedule Cs, and it's separate Schedule Cs and separate Schedule Self-Employment, the SEs. Now, again, they have to file joint returns. It has to be a married filing jointly. And this is only between married couples. Now, I know this sounds bad in today's world to say this, but according to federal law, this is only for married couples. Now, this can be same-sex marriages, that sort of thing is just fine. In states where same-sex marriages are legal, that is considered a married couple. But it cannot be just a domestic partnership, and it cannot be like a civil union. They have to be, for legal purposes, they actually have to be married.
What about a common law marriage?
Well, that's kind of the civil union kind of thing. A common law marriage is recognized by certain states. The state actually does, in a sense, recognize it as a marriage. So yes, technically it is.
Okay.
If the state recognizes it, that's kind of the condition. If the state recognizes it as a marriage and they are married filing jointly on the return, because remember, those are the conditions. These are the only ways they can actually claim it. And on the test, remember something. This is not to get into too much detail on this, because this isn't a major tax return, guys. This is, again, why I said the less used ones. On the test, you may be asked something like, married couples can file together. It's like, what are the conditions? That they must file jointly. They must be married. They cannot be, same-sex marriages are legally married, legal spouses. They are not, that are not in civil unions or domestic partnerships. That sort of thing. That would be the most of the questions you would actually get. You're not going to get detailed questions about married couple businesses. They're going to mainly ask you, what is it, and what are the conditions, and what forms are they going to file on? The form Schedule C, this form Schedule SE. They are filing separately. They are filing the percentage. Like Tina and Bob are married. They run a craft business out of their house. Tina puts about 75% into the business. Bob puts about 25% into the business. They had gains this year, sales this year of $5,000, costs of sales of $5,000 and costs of $3,000. What would each of them report as their income? As their adjusted gross income, basically, for the business. So you've got $2,000 left. She's at 75%. He's at 25%. So she would claim $1,500 and he would claim $500. Okay, that would be how it would go. All right, that would be the most you would have on a tax question in regards to the married couples. They're not trying to make it complicated in that sense. It's something that's only used, is mainly for the self-employment benefit and the Social Security purposes. Because it is a business, you can put in for Social Security. You can make the payments for Social Security because it's your own partnership. All right. But again, like I said, there is that condition. It is, some people are going to argue and say, well, what is the condition for? Why do you have to have this? You know, I'm with my wife or I'm with my husband. My state says we can't be married because we're a same-sex couple. Unfortunately, that state law is indicating that you cannot be married, that you're not legally married in that sense. And that is one of the only conditions. You do have to, by state law, have to be married, considered a married couple. All right. Any other questions on that one?
I have a question. You talked about the Schedule C or the Schedule SE stuff and they're filing that way. But I'm looking at the Pub 541 here, where it talks about businesses owned and operated by spouses. On page 3 is the top, on the right side, and it says that they should file. I'll just read it to you. Spouses carry on a business together and share in the profits and losses. They may be partners whether or not they have a formal partnership agreement.
Right.
If so, they should report income or loss on a Form 1065. They should not report income on a Schedule C 1040 in the name of one spouse as a sole proprietor. However, they can elect to treat it as a joint venture. And so
right.
I'm confused
That's
by
as
that. So
what's happening is it's saying that if they are setting it up like a business, they can do this to get it as a partnership. You can treat it as a sole proprietorship and not have to even, remember, there are benefits to being a partnership. Okay.
yeah.
Okay, so you have the benefits of a partnership if you want them. You can actually file it as a sole proprietorship if you prefer to. This is saying that you have the option of doing this, because it's not like it's saying you do. If you're doing this, you do not have to formally file anything. You have a partnership if you wish to, is what it's saying.
Okay.
You are not required to treat it as a partnership, but you can
so that's a
take
qualified
the
joint venture election. If they go with
right.
that, okay.
Right, that's what it's saying. You have the option of doing this if you have, what it's saying is if you have these things, you can claim it as if you prefer to. If you have the benefits that you want, this is, again, like I said, if you decide, I want to put some more into Social Security. Okay, I want it to count towards my Social Security. I want it to count towards whatever, I can do this as a partnership. As a sole proprietor, it's really difficult to do then for both of them then. As a partnership, they both can. That would be why you would elect to do this. All right, that's why it's a less used one. It's if you want the benefits of it, you're not required to do it, is what it's saying.
Yeah.
It's just if you want the benefits of this, if you have these conditions met, if you are married, if you have both partners, now again, that's the important part. Both partners are materially active in the business, so both of them are jointly doing it, so both of them are active. They can split the costs, split the benefits, and put it on their individual ones if they choose to. Okay, it's not a requirement. It's not saying you have to file this way. Is you can elect to file this way. All right. That's what it's saying is you don't have to, but you can if you prefer to. And there are certain benefits for doing so.
So I guess where I was getting confused is I thought you were saying the partnership qualified joint venture altogether, but they're two separate things. And so
right.
The partnership would do the 1065 if they wanted to be treated as a regular partnership. They wanted to do like the qualified joint venture for married couples, and they could still do the 1040 SE and Schedule C, split it according to their interests and in the business, the profits and losses, and then still file a joint return with those like sole proprietorships for each
of them. Correct.
Okay.
Now you getting it?
Yeah.
All right. That's what's important. That's all I care about is you're getting it. Like I said, this is an elected thing. You don't have to do this.
Yeah.
Okay. But as long as you meet this criteria, you can do this if you choose to. All right. Next one. And this is where we were coming into the Sheila's question with the little LLPs and things like that.
Right.
This is for a limited liability corporation. Now, this is a little bit different than most corporations. I mean, again, what is the problem with a corporation? With a C Corp? Double taxation. There you go.
Double taxation.
Double taxation. Thank you. You guys are catching on right away. A limited liability corporation, the company is another type of business. Now, it's formed under the state, just like all the others. So you do have to file for it. Okay, you do have to declare what it is. Now, depending upon how you file it, all right, it can be a single member, and that single member gets an EIN number, and then it's basically treated, in a sense, it works a lot like a corporation owned by a sole proprietorship, okay? And it's part of it for federal tax purposes. If it has just one member, it's treated for federal tax purposes as part of the owner's individual tax return. Okay, it's part of their tax return. It goes on their 1040. Okay, now I know that's hard to understand, but if there's just one member, okay, if they declare that it's a sole proprietorship or just, it can elect. Now, again, this is where it gets complicated, guys, so I'm going to spend a little bit of time on this. An LLC has the ability to declare at the time, it's a form 8832. You have to file it at the time, and you can tell the state what it wants to be, how it wants to be taxed, okay, how it wants to operate as. All right. It can be a sole proprietorship in a sense that gives this person a separate entity. Again, this is protection because it gives a separate entity that can own stuff, that can do everything, and it just basically passes through to them. It's taxed just like it's a S corporation in that sense. It gives all the liability to this, and just about all the liability. Let me rephrase that. Just about all the liability to the entity, and all the tax stuff to the person. Okay, which is really cool when you think about that. It's fairly easy to set up, but it would kind of work like a sole proprietorship. But you have to declare that when it's formed, that it's just me, and it's going to be for this business. I'm setting up an LLC with just me, okay? Or it can be, and now a corporate, now here again, if it is owned 100% by a corporation, that can be its sole owner. It can be that as well. Remember when we said about a corporation owning a corporation? Remember, corporate 1 can own corporate 2. It's just part of it, and this is the shell corp, remember? If this is 100% owned by this, all right, this one here is owned 100% by this one here. Okay, then it works just like it's a sole proprietorship. All right, all the stuff passes through, but all the liability, or most of the liability, remains within that corporation and doesn't pass through to the owner. So if there's a loss or anything like that, it stays there. If there's a lawsuit, it stays there. There are certain things that pass through, but it's very little that passes through to the owner. Okay, most of the liability stays right there. But they are taxed typically like partnerships. All right. Now, if it elects to be, now, it can elect to be a corporation as well. Now, at that point, it can have multiple members. And again, they are taxed. It's taxed to them individually. They have the benefits. It has its own body where the liability sits out here, but it passes through to them. It's like a whole bunch of little S corps, if you want to think about that, owners of an S corp. And it can elect to work that way. If it doesn't make a declaration, that it's going to be a single member or that it's going to be work like a corporation, then it by default, if there are two members, here's the important thing, an LLC, if there are two or more members, all right, it automatically becomes a partnership unless they make a declaration. Unless they make a declaration that it's going to work like one person like is going to run like a corporation, or that it's a single 100% owner. By default, if there's more than one member and they don't file a declaration saying it's going to operate like a corporation, it by default is a partnership. Okay? And what it means, again, like a partnership, think about what happens with a partnership. Each one is sharing the liability, right? I'm a partner, you're a partner, you're a partner. Whatever your percentage is, that's the amount of liability that you're taking in, right? So what they did was, I'm a partner, you're a partner, you're a partner, but the liability with an LLC still lies here for all of its lawsuits are within the corporation. So let's go to the whiteboard. Let me do it that way. I would rather you see this than not. Okay, because I know it's a little confusing, guys. So I would much rather you see this. So what we have is we have an LLC. All right. We have the people who own the LLC, which means we now have two options. It will either function as a corporation, okay, but it is still taxed, so it's a lot like an S corp. Okay, we're going to declare that it's like an S corp. When we say it's a corporation, I'm talking about an S corp. Okay, where the liability will lie here. Let me do this. Let me draw the liability. Hey, that actually, look at that. Okay, does that make sense? That's the liability will remain there.
Yes.
And it will be taxed as an S corp. So in other words, it will pass through back and forth to its shareholders. Okay. They then have the benefits of the taxation. Okay, it will pass through to them, not this. But if there is a loss, the loss, let me show this, it's only up to their investment level. Remember that, because if there's, that means, now we'll put this out here again so you understand this.
Mhm.
If there is a loss, it remains just here. Does that make sense? It doesn't pass through to the owners. It only stays, if there's a loss, it only stays with the members who are part of the LLC. Okay, and that's if it declares, this is if it declares that it is a corporation. It must, let me reflect, declares it is a corporation. And that's with a form 8832. Okay, does that make sense? So it's going to work just like an S Corp, basically. This is how you file. This is basically a modern day S Corp, if you want to think about it. It's another, it's the current form of an S Corp. They limited the amount of liability that comes through to the partners, and they set laws in place for it. Now, the one thing, it is a limited protection level for the tax benefits, with the tax benefits, but unlike a partnership, because in a partnership, the individual partners are liable for all that goes on. In this case, it's just the corporation that's liable. So none of the members of the LLC are personally liable for its debts, but it's treated like a partnership for tax purposes. And now this is really cool. As a partnership, what does it have to do? What does it have to do as a partnership? Because it is a partnership for tax purposes.
Form 1040.
Nope.
1065.
It must file a Form 1065 annually.
Well, Schedule K, isn't it? Same thing?
Well, it is, yeah, but it must file each year. And here's the important part. That's the important part. One of those owners is basically taking on some liability because he has to file the Form 1065 for the corporation. So it's basically the head person will have to file a Form 1065 and report it, okay, for the LLC, and one of them must sign it. Again, that's because this is basically a partnership, but it's kind of run like an S Corp. They took the best parts of, in reality, that's what an LLC is. They took the best parts of a partnership and the best parts of a corporation and tried to stick them together. Okay. And again, and here's what's really cool. This is open to everyone. Okay, that's an important thing. Everyone can basically open an LLC. Okay, remember that, because the next one we're about to explain, you'll understand why in a second. This can be Tina, Bob, Mike, and me. Whatever. Okay? Tina can be the person who files the 1065 because she's, owns the greatest percentage of the partnership. Okay? It declares that it's going to run like an S-Corp. We can set it up. But all of our liability is pretty much set up here. We're set up so that we don't have to worry so much about the liability. The stuff passes through to us. It's treated like a partnership, so we get our K1s, that sort of thing. Okay, we use the K1s on our individual returns. Okay, now that's if it's set up the one way. Now let's set it up the other way. Okay, let's not declare it. Okay, so now it's an LLC. Okay, and that LLC, now remember the past one I declared that I was going to run like a corporation. All right, so what happens if I am, and I'm going to actually change that color to, I'm going to clear that one out. We're just going to, all right, we're going to try this one more time here. This is the LLC. And so you guys can see them, because this is the important part. That is the owner.
One single member.
One single owner.
Yeah.
Okay. If it's one single owner, what it does, now this is why it's created. Again, let's go back to my liability circle. There is a little bit that may hit him. Remember, there's a limited liability. Getting a little more creative here, I think. This is liability. Remains primarily with the LLC. A little bit may fall on the owner, but it's mostly the LLC. But we're going to do this. For taxes, we will do this. It has pass-through taxes. So he has the liability sitting outside of him. All right. So the liability is out there, but he has complete control over it, and it's a single member. It is treated basically as a sole proprietorship for his tax purposes. It goes on his individual tax purposes. But all the liability is out there, and he has what for it? What's the most important part of this versus a sole proprietorship? What is the one thing that he has that a sole proprietor doesn't?
Limited liability.
What's the one thing? What do I have? What do I have as a sole proprietorship?
Total liability.
No. Come on, there's one. What's my number?
Income.
Oh, EIN.
Thank you. Anyone?
EIN, yeah.
Oh.
No.
That's the one biggest difference between the sole proprietorship and the LLC
See.
is because the sole proprietorship is under my number.
Yeah.
The EIN is here, protecting me. It's its own thing. So the liability falls primarily under that EIN. Do you see the difference? There's a little bit of, see, this is the liability circle. I tried to make it a little more understandable that way. This is the liability circle here, the red one.
Yes.
The liability falls mostly with the LLC. There's a little bit that can hit me, but most of it falls here where the EIN number is.
Yes.
Okay.
It's my question before, if an LLC can be owned by one person.
Yes.
If
Yes.
if the owner got EIN,
Mm-hmm. If he
he
gets an
became a
EIN for it.
corporation.
Yep, that's what he's doing. He's basically giving it its own number, so he gets all the benefits of the sole proprietorship now, but he is kind of shielding himself. There's a little bit of there's the taxes pass through, but there's a little bit of liability that it hits him, but most of it falls here within that EIN number. Now, here's the next add-on. Let me go back to this guy, and guess what I'm going to draw? I am going to go.
You're going to make the owner an LLC.
No, I'm going to add a second owner.
Add a spouse.
But wait, I have a question. The
Yep.
income or loss will be on the entity or owner?
If there's a loss, it will
Yeah.
basically fall. Let me draw my loss circle here.
Yeah.
Okay, we're going to draw the loss circle. Let's pick another color for it. That looks pretty
For the owner to okay.
Let me draw the loss circle.
On the entity.
This one is the loss circle. It's kind of cool that way that it doesn't fall on us. There you go. There's the loss circle. All right. Now, when it's this way, before this guy comes in, we're going to, assume this guy's not here. This pretty much falls on the individual's taxes, just the individual's taxes. Okay. So if I was doing taxes before, let me take this guy back out here. Okay. Let me take him back out. Whose taxes does this fall on?
The owner. 1040.
The owner. Thank you. I was trying to type it, but I wanted to pick a different color. Falls on a 1040 because it's basically just a sole proprietorship, remember? This is just him. This is just his taxes. So it falls through and passes through to the owner, and it falls on his individual taxes. Now, the owner, like I said, can be a corporation. This is 100% owned by him, okay? And it can still be treated like a sole proprietorship for that corporation, okay? Why, they may own 100% of it and they just want to pass it through. Remember, if they own an asset, this is how you would lock up an asset, okay? A corporation, you want to protect yourself, right? Think about what this does. Think about this structure. This is house one. This is house one. Back what we were talking about, this is house one.
Yes.
I can give another example. My son is an LLC, he's a DPE for the FAA, and his plane is an asset of the LLC.
There you go. That's perfect. And to protect it, you'd want to put it in its own LLC. Because remember, right now, if we do this the other way, and we're going to go this way, here's the LLC, and we're just going to draw this kind of off to the side here. This is LLC, and this is the
Asset?
asset. Okay, if you have it that way, remember what the liability is.
It remains within the LLC.
Okay, where does the liability fall, and where where do you get killed? Liability for all of that asset is right there, right?
Right.
Now, I'm going to change this. I'm going to just change this a little bit. I'm going to come in here, and I'm going to do this. And I'm going to change this back here. And I'm going to make LLC. And I'm going to, oh, I don't want to do that one. Let me go back here. Undo that one. I'll change this to a different color so you guys can see it. Now I'm going to have the asset here. Now what I'm going to do is I'm going to stick it, I'll take a little bit different color, but so you get the idea.
Asset of the,
I'm going to make,
whose asset is that?
that's part of this. Just wait, just hang on, you'll understand in a second.
Okay.
So I create its own, we'll just call this asset LLC, which is now, oh, I don't want that one, I want that one, owned entirely 100% by LLC. Now, do you see what I did here? Originally, that asset was inside here, okay? And all of the liability for it fell under this LLC. Now, what I did was I stuck the asset outside of the LLC, made it its own LLC, gave it asset LLC. The only thing in it is the asset, right? And it's owned 100%. So remember what I said? The taxes pass through when it's 100% owned, and it can be a corporation. That's the important thing. The owner can be a corporation. If it's 100% owned, it's just like a sole proprietorship. So, Corporation Bob, this one, LLC Bob, owns Asset LLC. Now, let's do the fun part. Let's draw our circles. Okay? LLC's liability, where does it fall?
Within the green line.
Right. I got to move it a little bit, but right there, right? Now, let's draw the liability circle for the asset. Where's the asset's liability lie?
Within the LLC.
Now remember, there is a little bit between an LLC. There's a little bit that passes through just in case something does happen. Because there's that little bit of pass through, remember? But does that look better? Sure looks a whole lot better to me if somebody breaks their leg at that house.
Now that amount of pass-through you talk about with the LLC for the owner, whether it's with the house and the asset LLC or the owner and the business LLC, just the amount of your investment in the LLC, isn't it?
Typically, yes. That's typically exactly what it's limited to is your
Which may be
investment.
a large amount in the beginning of a business, but
right. It's typically limited to what you invested in it, but there is sometimes some transfer over if you were responsible for the actions that carried over. So in other words, you did something that caused the issue. then you become personally liable in a sense. And then that's why I'm saying there is a little bit of overlap. Okay, it's a very little bit, but it's mainly based on your actions, how you controlled it, how you actually controlled the asset. If you were negligent in doing something here, if you, as a corporation, you didn't do the maintenance, you didn't do something that caused the accident, you can become liable in that sense. It becomes kind of a personal liability. Okay, so initially, most of this is zero. The only kind of crossover here is if you did something bad, in a sense. Okay, because you're the owner of an asset, you didn't use it right, if you want to think about it that way. All right, but does that look a whole lot better when you think about it in business terms?
Yeah.
Bob comes along and breaks his leg. Do you want to get sued? Lose the house, but don't lose this house, because you've got, let's see here, you've got this whole thing. Let me see if I can just duplicate it. Let me see here. I don't think I can just copy it. But anyways, this whole part, I don't think I can just do it. I was hoping I could just copy that and move.
Okay, I've got a basis question regarding this.
Uh-huh.
If I sold the house to the LLC,
Uh-huh.
would the basis then be the basis I bought the house for, or the basis that exists in reality?
The basis is what you bought the house for. It's
Okay.
still what you got it for. It just transfers with it. It's kind of like landlords. Okay. I have a contract with my tenants in place. All right. It's my asset. I own this house. The tenants have a contract for the next 2 years to live in the house at $600 a month. I sell this to Bob. Bob buys it. The contract is still in place, okay, for that 2-year period. It's still with the house.
Right.
The same thing carries over with the basis. When you bought the house, or you sold the house, when you bought it at X number of dollars.
Right.
When you sell it to someone over here, that X number of dollars goes with it. Okay, it doesn't just become what they bought it for at that time.
Okay.
It's still going with it at the time.
Okay.
So, and because it's still basically your asset, even though you sold it to an LLC, if you're just putting it into an LLC.
Right.
The thing it would change is if you actually profited from it, pulled the money out, then it would change. If you show a sale in that sense, then you actually have the offset for that basis, and you have to make the calculation for the transfer. If that occurred, then yes, it would reset itself.
Okay.
You didn't actually receive the sale benefit yet. Okay.
Right.
All you did was move it into, you just sold an asset in its current state. You didn't actually receive the consideration for it in that sense.
Right. Exactly.
Okay.
Thank you.
All right. But now let's go back to the first one here. Now remember, okay, does that make this clear for the LLC how cool this is? To throw your asset into an LLC. It does not take much. It takes a filing. But if I take this line away, and I take this away, and I take this, guess what? This, see if I can get it all. I think I did. Guess what? Goes with it. If I put it in here, and it's my asset in here, where's my liability? My liability from the asset
It's within the LLC.
is within my LLC. Does that make the picture a little bit clearer?
Mm-hmm.
Because I have to take this outside to get my liability out here.
That's another EIN?
It has its own EIN. It has its own filing. Everything, but the great part, like I said, is all the stuff has gone away because now you created that bubble again for itself. It's its own bubble. And there's just that little bit of crossover from the asset here for the liability. Like that. Does that clear up the picture as to why you would want to put it into the its own LLC?
Mm-hmm.
Because of that circle. That's the liability for it. And the asset has its own liability. You want it to hold its own. So to do that, you have to give it its own LLC. You make it its own asset LLC. And that protects your home LLC. Does that kind of clear it up, why you would do that?
Mm-hmm.
And remember, like I said, this is 100% owned by this. So it gets all the pass-through. So it just appears on its regular taxes. In this case, I should say, now it appears on its regular taxes. Okay? The reason I said that is because an LLC here does not file a 1040. An LLC here files its own 1065 or whatever it may be when whatever it's declaring itself to be. Okay, so instead of a 1040, this would be filing a 1065, and this would be one of the assets of the 1065. Okay, but it goes through whatever they normally file, it would go through to it, and it would go through to it just like it's a sole proprietorship, just like there's no blockage. Okay? Did that make it clear on that, I hope?
Yep.
Everybody clear? Naomi, Garrett, Lisa?
Kind of. I missed a
I'm
couple
clear.
classes, so I need to go back so I understand.
Okay, but no, but Lisa, here, let me ask you this. Do you understand where I put the circle of the liability there, the red circles or the liability for each thing? If I take the asset and I don't give it its own asset LLC, all of its liability then falls here because I'm moving it here. If I don't give it its own LLC, the asset, see this one, asset LLC, is over here now. This now falls because I didn't make it an LLC. All of its liability, that's its red circle, falls within the parent company. So Bob comes and breaks his leg. Bob comes to the house, trips, falls, breaks his leg, hurts himself, whatever it may be. All of the liability now, in this case, falls within the LLC. If I create an LLC, I created its own entity. Here's Asset LLC. And I move it into it, giving it its own LLC, making it its own business. What goes with it is its liability. And so it comes over here. Now the LLC is protected from it. It has its own little shield from it because of this. Okay? Does that make it a little bit clearer?
Yeah.
At least I hope it does. Okay? All right. Now, again, like I said, what was the important thing here? When it's one owner and it's just a person, not a company, because a company can do other tax returns. Let me get this out of here. What did I say here about the 1040? This is a single person. He's going to file it on his 1040, right? Now, what happens when we do this? And what we end up with here try to keep it a little uniform. Is owner 2. What happens to the LLC?
It becomes a partnership.
There you go. It changes a little bit. So let's think about those changes. So let's start drawing in where, remember, these are our taxes, right? The green lines here are our taxes. So we know automatically we've got some taxes here, right? And I probably should move him a little bit closer because there's some liability. So let's put him in here. And let's move him in a little closer here. Right? That's owner 2. And we can see his taxes are passing through to him now. Now, what happened to this? We know it can't be a 1040.
1065.
There you go. It automatically, if there's more than one member, if there's 2 members or more, and they don't declare that it's a corporation, okay, they don't declare some special corporation for it, it automatically defaults to this LLC. You know, if they declare it's going to be something else, you know, that it's going to be some type of S corp or whatever, it takes on that, and they file that form 8832. But in this case, it automatically becomes a partnership. Okay, it's treated like it doesn't become a part. It's still an LLC, but it's treated like a partnership. So what happens?
LLC?
It's an LLC, but now they have some limited risk. They have they have a partner, and this is basically based on shares now. Okay, this guy doesn't own 100% anymore. They can own 50-50, they can own it whatever, but now it's just like a partnership. Okay, it passes through instead. Now think about that. That's important now. With a partnership, what's the problem? If I look at a partnership, what does a partnership normally have? Remember that red circle? In a partnership, if I go like this, and I look at a partnership, and let's say this is just
liability.
Where's all the liability go in a partnership?
With the owners.
There you go. All the liability falls 100% on those guys based on their percentage, right? That's where the liability is. What they're doing is by giving it an EIN, they take this circle, and they shove it over there. That shows you basically what the liability does. When you form that LLC, it becomes a partnership, but the partnership liability that normally exists no longer exists. They now have shifted the principal liability, in other words, 99% of the liability, onto the corporation. But it has all the functioning of a partnership. They have all the tax benefits of it. They file a 1065, just like a partnership, and they run it like a partnership. Does one own 50% and the other one 50%? Does one own 49.5 and one own 49.5 and one own 1%? Because you can have 3 partners. Okay. And that's how it works. It defaults to be a partnership if you don't declare it as something else. Okay. It's really a sole proprietorship if there's one owner, but all the liability functions, and it goes on your 1040, and the functions, but the liability rests on the LLC if there's one partner and 100% owned. If there's more than one owner, okay, it defaults, unless they declare it as something else, it defaults to be a partnership. It's kind of a multi-function. If you think about this, an LLC is a Swiss Army knife. Remember the Swiss Army knife? You open it up to the blade you need. Okay, I need a partnership today. There's a partnership. I need a sole proprietorship. There's a sole proprietorship. I need a limited liability corporation where I'm a corporation and I need to, okay, it's a corporation now. It's an S corp basically. Okay, that's what an LLC does. It kind of functions how you need it and how you declare it. Okay, does that make sense?
Yes, but the owners, they shared the liability.
No. In this case,
Why is
remember
there intersection?
this little bit. Remember this little bit here?
Yeah.
This is only that's why it's called a limited liability. There is a chance that if they do something wrong, remember, there is a little bit of liability still. Remember that word, limited liability company. Okay. Now, what are the important facts? Let's go over some facts. Okay. The first most important one is it can be for any type of business. Okay. Number two, it can be a sole proprietorship. I really shouldn't call it a sole proprietorship, but it can be basically a sole proprietorship with, I can't type because I was thinking, with an EIN. So it has the limited liability in that sense. It shifts the liability over. It can be a partnership, okay, with a 1065, or it can be declared as a corporation, and it can be filed on the corporate taxes. All right. And it can be done by anyone. All right. Can be, how do I want to put it? Owned or issued. Owned by anyone, including a corporation. So in other words, a corporation can own an LLC, just like we were doing. My corporation owns my house, owns this house to protect the corporation from the liability of that house. Okay? Those are some of the main parts of an LLC, and that's why an LLC is so cool. Okay? It passes right through. It's an S corp. It's an S corp that I just created and stuck and made my asset protected from me. All right? I don't have to worry about it. It gives you all that protection with the tax benefits of a partnership if you're doing a small one. It gives you the tax benefits of a sole proprietorship if it's just an asset you have as a single member. Okay? You don't have to worry about it. It's reported on your 1040.
Yes.
See, I'm a single person. I own 5 rental properties, right? I'm the single person. I own 5 rental properties, right? I just want it to be 100% me. All right, so I throw it into an LLC. I'd usually want to stick an LLC between me, but I didn't think of that. So it's just on my 1040, right? That LLC goes to my 1040. That LLC goes to my 1040. That LLC, because I just created each one in an LLC, goes on my 1040. Okay, because I own each one individually. They're all individually my assets, and I own 100% of them. Well, I would probably want to stick an LLC between us to protect me personally, but hey, they structured it that way, right? But remember, an LLC is basically the switchblade the Swiss Army knife of business. How is it structured? What did you declare? And what is it now? Okay. It's a partnership by default, automatically. If there's more than one member, okay, 2 or more members, and you don't declare it as anything else, it just defaults to be a partnership because that's what it is. But all the liability falls mainly on the LLC. All right. Does that make sense for you guys?
Yes.
I'm hoping.
Yes.
I'm hoping it's fairly clear.
Uh-huh.
All right. I'm hoping that was pretty good. Now, let's go on to the next one. Now, the next one is a little bit different. Now, you're thinking, well, isn't that just a limited liability or limited liability partnership? Let me do this. Let me stop this share. And let me share this. All right. Is it showing my LLP there?
LLPs, yes.
Okay. Now, this, you're thinking, well, wait a minute. Isn't that just a partnership? Why don't they just call it a limited liability partnership? Well, the limited liability partnership is a special one. When you have things like CPAs and law firms and things like that, doctor's offices, some doctor's offices run this way, where you have multiple specialties within a doctor's office. What happens is this CPA and this CPA, or this attorney is a better example, and this attorney are working in the same office. You know, you've got Cook and Cook Law Firm, okay? Well, in a partnership, I am representing my client, and I'm representing him well, and I've gotten through thousands of cases. And my nephew's an attorney, and he's with me, okay? Cook and Cook Law Firm. But he's doing great, but he's just starting out, and he ended up with a big case. So he ended up with a big case, and he's really nervous, and he screws up the case. Okay, he missed some evidence, blew it off, whatever it was, and he is in trouble. He's being sued by his client, he's being whatever. Guess what? If I am a corporation with him, where does my liability fall? Okay, let's go back to our neat drawing here. And I'm really beginning to enjoy my whiteboard more and more. Clear all drawings. Now let's start again with here is, I can't type my own name. Cook and Cook Law. Okay? Sounds good to you? Sounds good to me. Cook and Cook Law. And what I have, if you think about it right now, we've got our members. We've got this one, and this one, and this one, and this one is me, and we'll say this one is my mom was an attorney, and this one is my nephew. Okay, this is our law firm. Now, let's start with the worst question ever. With this, we created our law firm, and we just created our regular good old-fashioned corporation. Garrett, where is my liability? If I just created a regular corporation.
It is within the corporation itself, so mom, me, and nephew would have some liability.
That's going to be our liability. Oh, I would hate that. That would really suck, wouldn't it? That is your liability for all the members in the corporation. All right?
Yes.
That would be a normal C Corp. And it would hurt, because if something happened, somebody makes a mistake, who's going down?
All of you.
All of us. All of us. So what we do instead is we have a limited liability partnership. So what we do instead is we do this. We take that liability and we make basically a partnership. But the liability is by the individual person. So liability goes like this. Okay, it's not what I wanted to pick up, but that's good.
Copy.
Yeah, I'll just draw it out here and move it over there. There we go. His liability is right there. And my liability is right there. Got to draw my circles better, but you know what the heck. But anyways, there's my liability. I shouldn't have any over here in Mom's, but you know, hey,
Yeah.
it happens. So there we go. Take my overlap out. Now, there is one other thing that's kind of missing here. What is it?
Tax.
No, the taxes, we treat this as a partnership. Each one gets their individual share. There can be a senior partner.
Okay.
But there's another kind of little bit of thing here that we kind of missed.
Well, each person's liability falls for their own mistakes or their own whatever's, right?
Uh-huh.
So it's divided liability.
Except for one thing. There is another circle. That is the liability what this is let's say that something happened at the corporate level. Okay, these are for things that happened within the law firm. Okay, in other words, these are for my actions. Okay, these are my cases. These are my nephew's cases. These are my mom's cases. But there are things that somebody walks into the law firm and trips. Okay, there are common areas, if you think about it. There are things that we have jointly in this. And we each share that liability based on our percentage. So there are some that we do share. This is my liability for my actions. All right. So in other words, for whatever I do, hey, I can actually make that smaller too. I can make that actually fit better. So this is my liability for my actions. This is the liability for my nephew's actions. This is the liability for my mom's actions. But if the secretary does something, okay, remember something. The secretary is not a partner. She's an employee.
Mm-hmm.
My IT guy. So we have these are the partners are liable for their actions, but we also have employees and their actions that we are jointly liable for as a company. Okay, so yes, we are liable for our own individual things, for our own individual actions. So malpractice falls just under each of us individually, but the actions of our employees falls under the corporation. In other words, all of us collectively. Okay, does that make sense?
Yes.
Yes.
Because we're going to have two types. We've got my actions that I'm doing as a partner. So we've got the partners, and then we have employees who work for us, who are really part of our corporation. We are all jointly responsible for their actions. Okay, so that's the important thing. We are jointly responsible for our employees, but we are individually responsible for ourselves. All right, and our actions. So that is an LLP, a limited liability partnership, and it can only be certain firms, and that's the other thing. Remember what an LLC can be? It can be anybody, right? Anybody can make an LLC. It can be a corporation can make an LLC. Individuals can make an LLC. Partners can make an LLC. An LLP can only be made by certain firms, mainly a law firm or CPAs or things where it's an individual and they are jointly using kind of community property. Okay, if you want to think about that, they're professionals. It's often, let me put it that way, it's often professionals who are working together, and real estate agents, believe it or not, are a special type. Okay, we'll go that way. That jointly own, and they have ownership. Usually, that is one of the most important things. An LLP is usually owned by the employees. In other words, the partners themselves usually own it. Okay, and if you think about a law firm, who owns a law firm? Usually the partners. All right.
Aren't those called in Oregon? Aren't those called like professional corporations?
Basically, yes, they're considered a professional corporation. They're professional services. Okay, that's one of the things to consider. A limited liability partnership. Okay, it's formed under a state law, so you actually have to file it. It's not a, it doesn't automatically kind of form like a marriage, and it's used for professional services. Now, the best example, like I said, is a law firm or a CPA firm. Each partner actively gets to participate in the management. All right, they each one based on their ownership, but they're personally liable for their partnership debts. Now, that's the important thing too. They are liable as a partner, just like a partner. Okay, that's the other thing, taxation. They are liable for their individual losses. Okay, let's talk about that. Because one thing we didn't show here, and I should have shown, is our income lines. It's really not a line necessarily with that. It is going to be this. And it's usually given as a percentage as their, because this is a partnership, remember. I did not draw that circle well. There we go. I did not draw that circle well either, but hey, we'll live with it. In a limited liability partnership, remember, that's their income too. Now, there is then a group income, because remember, their ownership, how they structure how they're getting paid and what they're liable for is structured within the partnership. I get a certain percentage, you get a certain percentage, and it's usually of the profits. That's how they get it. It's based on your percentage. This is considered then, what would all of the stuff in here, all of the employees be considered? All the employee salaries, what would that be?
Business expense.
Business expense. They're not paid as a percentage of it. They're a business expense. All of their income is basically based on the profits. Okay, that's how they get theirs. They get their profit after this business expense. So it's really hard to draw a line when they're inside of it, but you know what I meant. They get a percentage based on their ownership of the company, and this is all a business expense. Okay, does that make sense? But the liability falls within each of their own areas, and then the collective liability based on the corporate actions for their employees. This one, they're all responsible for. This one, just they're responsible for their actions. The liability here falls within each one of their own malpractice areas. And it's a professional, doctor's offices. I'm trying to think of some of the best examples. Sometimes that doctors will get together, each one has a section of a small practice. Okay. And that often happens with an LLP. You know, 5 doctors get together, they form an LLP, each one has a specialty. That forms a doctor's office where they handle family practice, gynecologist, usually general services, family practice, gynecologist, and usually some type of medical urgent care treatment. Not an ER situation, but just kind of an urgent care thing. And the 3 of them will get together and form a small medical facility. The 3 of them now can cover when somebody walks in, handles regular family practices, general kids. Pediatrician will be the other one to join that group. Now you've got one that handles general services for medicine. They together collectively would handle each of their own individual areas, and they form an LLP. So it works as a partnership. Their liability is what each individual group does, each individual partner does. But as a group, then when somebody walks in the door, they're liable for their actions of the employees as a collective, and they're liable for anything that happens within the general area. Was that clear? I hope.
Yes.
Lisa dear, how'd that go?
Yes, I get that.
Awesome. That's what I want to hear. Sheila,
Yes.
was that good for you?
Yes.
Did
Fine.
you get that? Awesome. Thank you. That's what I wanted to know. All right. That is a limited liability partnership. Okay. And like I said, it's not, each one is just a little bit different, and these are just specialty groups. All right. Let us close this one out. And let me go back to this. And go to this one. We only have 2 more to go, so we're good. This one is really strange. Okay? They're a personal service corporation. They are a specialty group entirely. They have to be they're a special group literally of different types of corporations. They have to be, believe it or not, they have to be specific activities. They're personal services. They don't manufacture anything. Okay, they don't have a product. They can only provide a service. They also have things, there's a couple in here, health, law, performing arts. There's also secretarial ones. Well, down this list, accounting firms, they can get together and form a personal service corporation. All of its principal activities has to be a service. Okay, no products are produced. Actuarial services, architecture firms can form Pscs. Because if you think about it, they don't produce the building, they just design it. Usually these are, and that's actually probably one of the best examples, these are a lot of times designing firms because somebody comes to them, says, please design this for me. They produce the engineering plans. Okay, well, that's all they do. Or they go out and actually do the surveying and that sort of thing. They're often a middleman. That's why it's architecture, law, things like that. Healthcare. There's a lot of the ones where they don't actually produce a service there. In other words, the urgent care offices, things like that, can actually form a personal service corporation. when we were talking about the LLP. Okay. One of the things that can happen is, remember when we were structuring this law firm, Cook and Cook? What you can do is that area that we said was the common ground, where the liability falls for the secretaries and whatnot, you can actually make that its own corporation to shield the stuff around it, make it its own PSC, its own personal services corporation. And then the liability falls within it, and the partners own it, but it shields the partners from that. So remember stacking again. Now the most important part, and this is probably the strangest thing, PSCs are taxed at a flat rate. They do not have to do any calculations. They are taxed at a flat rate of 35%. S corporations cannot be a PSC. They can't be a pass-through. It only can be a C corporation. Cannot be a PSC. And again, it's a special designation of the company. It is owned usually by its employees. So all of the ownership of a PSC is usually owned by the people within it. Because if you think about it, it's not a partnership, so stock is owned. Okay, so it's a corporation. It's just like a C Corp, S Corp. A PSC is a corporation where stock is owned. So it's normally not invested by the outside because the services are usually performed by the people within it. The architects, the dancers for the performing arts, or the accountants, the consultants, they usually are the ones who own the company. But again, they cannot produce a product. It can only be a services, and as a result, they can declare it and they get taxed the flat rate of 35%. Now, there is a rule that if a taxpayer makes an S election and has his income directly taxed as distributions, the 35% rate does not apply. So he doesn't get that 35% rate if he does an S election for his taxes. If he's trying to get, like I set it up as an S Corp, the 35% does not apply. It goes back to the S Corporation rate. It's very rare if you think about it. I can think of a personal service corporation being set up for a lot of different firms, but I'll be honest, I don't think I would want to be taxed at a flat rate of 35%. I can usually figure out ways to get around a whole lot of taxes. Anybody think of why you'd want to be taxed? I can honest to God think of no reason why I'd want to be taxed at 35%. But it does exist. I mean, can you guys think of a reason you'd want to be taxed at 35%? Because I know I can get things most as expenses, and I can start working it so I can look at what my expenses are and whatnot. So I can't think of too many PSCs I would want to build. It's just one of those things. But it is a tax. The biggest thing you need to know for the test is a PSC is a service corporation, so it cannot produce a product. It is typically accounting or architecture or consulting or engineering, something along like that, law, performing arts. Naturally owned by the employees, okay, because they are normally doing the work. And it's taxed at a flat rate of 35%. That is the whole thing of a personal service corp. Can anybody think of an example of one? Another example of one. What would you think of as a PSC? Any examples?
What about a hair salon?
That is a service one.
Manufacture anything.
Yeah, that
Service
is one.
corporation.
It can be a service corporation.
Not that I visit those regularly or anything, but just
yeah. But usually,
massage.
massage places.
Spa.
But usually, think about it. Each one of those are typically employees. They're not actually individuals. They don't do their services in that sense. They're usually employees of the company. These are usually think about it. Accounting professionals, that sort of thing. Actuarial services, numbers, insurance, that sort of thing. Architecture, doing engineering, consulting, all design
those
professionals.
are all listed. I was trying to come up with something that wasn't listed there. So.
No, I know. I was thinking, but each one, a hairstylist, the one thing is the difference is all the ones that I just named are usually self-employed. Okay, if you think about that. Engineers are usually self-employed. They usually don't work for someone. Consultants are usually self-employed. Architects, self-employed. In a lot of cases. The hair salon typically is not usually self-employed. They're usually employees of the salon. Now,
well, unless it's just a small mom out of their home, like a salon, possibly.
That's possible. Yeah, there you go.
How about like a computer repair shop?
That might be too. There are some, yeah, because he's, those are examples of something that could be owned by the employees.
What about like a software engineer? He'd be under engineering, computer software engineer who goes and does jobs for specific different companies, but he's his own business.
That's quite possible, yeah. That's quite possible.
Like
it's services only, so yeah. But then again, like I said, think about the thing is the only benefit to it is you're being taxed at a flat rate of 35%. I don't know. I think I'd figure that's pretty high when I think about it. I'm going 35%, bud. I can probably do, So when you go 35%, I don't know about that, but maybe if you calculate it that way, it's not I don't know if I just personally, I don't see that much of a benefit for it, but it exists. It's taxed at a flat rate of 35%. So as in a business sense, it's something you guys do need to know.
Aside from the performing arts industry, most of these are the types of services that you have a lot of liability built in with that in terms of what you do. And
true.
Sued for that pretty heavily. You have to carry some pretty heavy malpractice insurance and stuff, like a doctor or a lawyer or health professional type.
True. I can see that one. Accounting.
Like a guy who does what do they call those guys? The guy who puts you to sleep. The
anesthesiologist.
And those guys are pretty much private within themselves, but they work in the operating room with the doctor and everything.
Right, but they have their own services there.
Yeah, you can file them individually too. So.
Yeah. Yeah, I don't know. I'm just trying to think of something. 35%. It seems like it's awfully high, and
It is. Yeah, I'm just wondering why you'd want to take that on. But I guess if you have a lot of experience,
that is one of those questions I just don't know. Sheila, do you know of any corporations you know of that are set up as a PSC?
No.
Because like I said, I can't think of anything I'd want to ever have taxed at 30%.
We've seen talk about that much in the in this book on partnership. So.
Yeah, no, it's one of those things that I wouldn't ever really form a PSC personally, but the flat rate of 35%, why? So.
Are we going to touch on nonprofits at all?
Yes, as a matter of fact, that's actually once we're done with the farmers, because these are the last ones of the business ones, and then I'm going to go entirely into the nonprofits, which I love because I've had to set them up for the church and all, so we'll get into that. I love that. That's actually right after lunch. So, okay. So the next one, before we take our break, is this is a really special one. Okay, it has its own special section. It has its own special pretty much everything. Can we see that on there? Farmers and fishermen.
Yes.
Okay. Farmers and fishermen, it's a special category that's created specifically for them because of what they do. We need them to survive. Okay, period. We need them to be in business. We need them to stay in business, because if they don't, we will die. Okay, pretty simple. I mean, when you think about it in those terms, if we don't have food, milk, trees, you name it, we will die. So what we did was we realized that years ago, that was the main product that a lot of people produced. Everybody was a farmer. I mean, most people were farmers. That was, a few people were merchants, but most of the people were farmers. They produced stuff on their farm. They sold it to somebody in town or sold it to somebody else, and ran their own business basically out of a house. So it has specific requirements, and it was set up by Congress that so that it affects specifically them. It has to have certain categories that it falls into. It produces crops, corn, grain, wheat, whatever you want to put it as, something along those lines, tomatoes, okay, dairy products, milk, cheese, things like this. It has to grow them, be the things primarily for it. Chicken, livestock, fish, timber. It has, trees fall into that category, because they all basically, if it grows, okay, that's one of the requirements. It has to be something you grow, okay, or get out of the water, if you want to think about it that way. It has to involve plants, trees, fish, or cattle, some kind of livestock. If it falls into any of those categories, it is the category of farmers and fishermen. Now, they did this because, think about it, if we don't have potatoes, hang on a second, there we go. If we don't have potatoes and stuff, we aren't going to survive. Okay. But when you talk about California, what is the other name for California? We think about California, we think about what? Movies. We think about what? Surfing, beaches, right? We think about California. Oh man, we got the beaches. We got
from the valley.
You go inland. California is known as the breadbasket of the United States. Did you guys know that? Do you know why it's known as the breadbasket of the United States? What is the weather like in California?
Sunny most of the time.
Really important, that one.
Same as Florida.
But Florida has a couple of problems. Florida is mainly sand. Okay. What is Texas?
Same.
Nope.
Places I was, it was all sand.
What does Texas mainly have?
Livestock.
Oil.
Thank you. She got it. Thank you, Sheila.
They have this kind of dirt it's called creechy.
It grows grass, baby.
Yeah. And they have very little topsoil.
There you go. It grows grass. So what does Texas produce? Livestock. Cattle. You got all those Texas ranchers. There you go. Sheila got it right on the nose. Okay, so you got California. Its weather all year long is pretty much sunny. Okay, you come up into Oregon. It rains a lot, but guess what? It grows a lot. Go to Idaho. What does Idaho do most of the time in most of its places? Potatoes. It's a perfect growing thing for potatoes.
It's
The
like
gorge. The gorge. What does it do? 99% of the gorge does what?
blows wind, fishing,
Thank you, but it grows what?
fish,
Timber.
Nope. Missed it all. What's the biggest export from the gorge?
orchards.
Thank you.
I didn't think I just was looking at your list
Cherries
here.
and apples. Why do you think they call Washington the apple state? They grow right here. Whatever it is, the climate here in this chunk up the gorge is unbelievable for growing two things, cherries and apples. For some reason, they grow like weeds here. Okay, just as
Like
one.
orchard crops are hazelnuts, and it used to be hops. Washington and Oregon is the highest producer of hops.
There you go, hops. The hops production, because it's just like Europe. That's also why we grow the grapes. Do you know that there are sections in southern Oregon where they say it's the exact same as France? That's why they actually planted the grapes here, because they said it's the exact same climate, exact same humidity, and the exact same situation as sections of France where certain Rieslings grow and certain Merlot grapes grow. Because Merlot actually is a type of grape. Most people don't realize that. Merlot is a type of grape, not a type of wine. Merlot wine is the wine made from that specific grape. Well, it only grows in certain areas. So there are certain areas in Oregon that grow that exact grape. So what do? They grow it like crazy there. Okay, because certain plants will only grow in certain areas. Well, so you're growing up that crop. Now think about it. Okay, really hot, really flat, most of the time, what do you grow?
I used to grow a lot of grass seed here in Oregon.
Oh, you're getting there. Almost. What is a grass seed? Believe it or not. What is the tallest? Keep going, keep going. There's one that, believe it or not, is a kind of grass that is 7 feet tall.
Oh, you're thinking of marijuana?
Nope. There's a kind of grass that is
Hemp?
7 feet tall.
Hemp?
Believe it or not, you won't believe it's a grass.
Rice seed, ryegrass.
Keep going.
Corn.
Thank you. Lisa got it. Corn is actually grass. Okay. Corn is a form of wheat. Okay. I know we don't think about it that way because it's 6, 7 feet tall and growing in these tassels and whatnot, but corn is actually grass. It is an insane form of grass that forms these tassels, which we eat. It grows in extremely hot environments, and then it dies. We harvest just that end piece, and for us, we do all kinds of stuff with it because that makes alcohols, that makes oils, that makes corn food, all from that one source. Okay, now let's go to the potatoes. What ends up happening with those? They grow in the dirt. Now, luckily, because the dirt is really important, for whatever reason, what does Idaho have in its dirt?
Minerals.
Yes, just about. What's another word for it? Think about the bottom of the ocean.
Sediment?
Yep, it has silt.
Silt.
What ends up happening is most people, you got to go back 10,000, 20,000, 100,000 years ago. What was North America?
Well, the inland was a big sea.
Thank you. It was underwater. The Cascades and all that. Mount Hood was basically an island. Okay, this was all underwater. The gorge was formed by water flow. You're sitting there going, what? The gorge was formed because it was an underwater river. Okay, it was part of the ocean bottom. And what happened is the Cascade Range and all on the eastern side, yep, Idaho is stuck, big state. Now, we don't think about it in these terms. Think about these on planetary terms. Idaho is stuck between the Rockies and the Cascade Range, right? Two great big mountain ranges. So what happens in Idaho?
All that runoff from the
Dirt settles there. You're at the bottom of an ocean now, Garrett. Now think about it this way. You're at the bottom of an ocean now. Dirt settles there and it doesn't move. It just starts to build up. And that's really nutrient dirt. So now it's another 100,000 years later and that water is gone. What do you have there? Top layer of Idaho.
great topsoil.
Awesome topsoil. Where do potatoes grow?
In topsoil.
Thank you. They grow under the ground right there. Yep. Top 3 feet of dirt. They start growing in. They just basically eat up that couple of feet there, the topsoil, and that's where they grow. And for whatever reason, Idaho, it's settled between the two. And it grows when Idaho is warm. That period there where Idaho, so Idaho has what's known as a growing season. Okay, think about that. Real big point here. Idaho has a growing season. All right. Now, what happens if, for whatever reason, okay, let's go to Florida. Let's talk about Florida. What does Florida produce?
Oranges.
Thank you. You guys knocked it right out. I love you guys. For whatever reason, that tree grows like crazy in Florida. Why is that? It's a tropical fruit. It's not native to Florida. It was brought here. Okay? Turned out when they planted it, it goes crazy there. Dies everywhere else. Grows like it's insane there. Do you know why apples grow in Washington? What happens if you put an apple tree in Florida? Why doesn't it grow?
Sandy.
Too hot?
Thank you. You got it, Sheila. What ends up happening is apple trees actually like it cooler. Apple trees do not like growing, cherry trees do not like growing in hot weather. They like growing in cooler weather. That's why Washington, its apple season is earlier in the year, and they kind of think, the leaves, when do the leaves start falling off the apple trees? October, man, they're pretty much dead. Okay? Because they like a cooler thing. As soon as it gets too cold, they're gone. If it's too hot, they don't produce any apples. They've got that little growing temperature that they happen to fit in the hit that gorge. It's the right temperature. That's the important thing. It's got lots of nutrients because it's part of the gorge there, and it's got an incredible temperature range, just right for it. Okay? Florida, those trees cannot survive here. You ever tried to grow? Who here? Okay, Noemi, tell me something. What's calamansi?
Calamansi, yeah, like.
What in U.S. terms? What's calamansi?
The yellow one.
Yeah, they're lemons.
Lemons, yeah.
Lemons. They're an Asian lemon. It's a little green sucker about that big, and they taste just like lemons, but they're a little bit tart. They're a little bit stronger than a regular lemon.
Yeah.
Think about this. Half of my family here, well, Noemi and all, are all Filipino. What do they want? They want calamansi. If I go outside and try to grow calamansi, guess what? What is the Philippines? If I go to the Philippines, what is the Philippines?
Hot. Yeah.
Average temperature is 76 degrees and muggy. Really humid. Okay? So, does that sound like Portland?
No.
Does that sound like Washington?
No.
Does that sound like Florida?
Maybe.
Like it, yeah. Florida.
Mostly, yeah. It's kind of like more like Florida. Okay. So it has a chance of growing in Florida, but it ain't going to grow here.
Mm-mm.
You know, problem is it's just probably not going to grow here no matter what I do. Here's another one. Ugh, and I hate this one. Okay, how many of you guys love bananas?
Oh, I love banana.
Yeah, all of us love bananas. I love bananas. My wife has, you forget, we have property over there. Okay, I own a house over there, and we have her aunt's property is actually a resort in Pangasinan.
Okay.
So guess what they have over there on the property? A ton of them. Banana trees, coconut trees. Okay, they grow like weeds over there. All right. If I want to try to grow a banana tree, does it grow in my yard?
It might grow.
It might grow. If I baby the heck out of it, it might grow. Is it ever going to produce bananas?
Probably not.
Oh man, you can try and you can try and you can try and you can try. And it's like, if God looks down on it and goes, okay, I'm going to give you a banana, you are lucky. Okay? It's like, banana trees do not grow here. Okay? They grow over to our house over there. They don't grow here. So all of these crops are really specific. You go down in the South, baby, what do they produce? What does the South produce? It's got two big ones.
You're thinking cotton?
That's one.
Tobacco?
That's two.
Tobacco?
Listen to those two. Man, they knocked it out 2 for 2. Two biggest things down in the South, cotton and tobacco. And what's the important thing about tobacco? It didn't come from the South.
No.
It came from Europe. Okay? They snuck it over here. It was illegal to even bring it over here. Okay? Jamestown Plantation, Jamestown, when it was originally founded, they snuck tobacco plants onto the ship so they could get it over here. And what happened? Oh my God, it was an environment like you would not believe. It grew like you would. Oh my God, the people over in Europe hated us. Okay, we could outproduce Europe with this stuff. It was better growing here than it was there.
Very heavy feeder.
Yep, it just went insane. You start planting that tobacco, it just... Okay, so we got southern states producing tobacco. Oh, here's a big one now. Here's a big one. Okay, in Colorado and in California, we'll narrow it down to those 2 states. What is going to grow in California so much better than in Colorado?
Anything.
But there's a big one. Requires an unbelievable amount of sunlight. You already named it earlier. And this crop is worth a ton of money.
The marijuana.
This is a crop that until the late 1800s and the early 1900s is perfectly legal. Is again in some states, but has a requirement to grow. Guess what? Does it grow well in Washington?
Yes.
No, it does not. Does it grow well in Oregon?
No.
No, it does not. Do you know why?
Too wet.
It is a high sunlight plant. In other words, it requires direct sunlight to grow. Does it grow well in Colorado? Any guesses?
Yes.
Nope.
I know.
It grows terrible in Colorado. Do you know why? Colorado is the Rockies. It's cold.
Elevation too high, yeah.
It is cold. That's the Rocky Mountains. It is cold. It does not grow really well up there. What is California?
Hot.
Hot.
Hot and sunny.
Dry, yeah.
Guess what grows crazy down there? Marijuana.
Yep.
So.
That's what I said.
Yeah.
You got it. No, I'm saying you got it. You got it. At least I was saying it.
Oh, okay.
I said you got it. You named it. Marijuana grows in California and the hot states, Mexico, Nevada. Doesn't grow so well in Nevada, but you got to plant it, and I guess in better soil because it's so sandy in California. I mean,
That's why they have the grow rooms.
Grow
because
rooms,
we
but
have to have
yes,
the lights.
that's what our way around it. We create what do we do? Think about that. Now again, let's go back to tax purposes and farming. Okay, now this is all related to farming. Well, how do we make it then? I just said what grows naturally like a weed in California.
Weed.
And does not weed and does not grow in Oregon, Washington, or Colorado. Weed. How then are they going to grow it and farm it in Oregon, Washington, and Colorado?
Artificially.
Artificially.
Yeah.
They are going to create grow rooms. They are going to create the growing environment. Okay, they're going to become modern day farm. Guys, what is that? That is a modern day farmer.
Like hothouse tomatoes.
Okay. There you go. You're starting to catch on. So if I go back 200 years and I'm a farmer, what did I do? I had to find what?
The right environment for your crop.
The right environment for my crop.
Reproduce it, yeah.
The right environment for my crop. That's perfect, Sheila. I had to find out what would grow there. And if I was in the wrong environment, I had to get something else that would grow there. So let's say I own this piece of dirt, and I needed to find out what crop would grow there instead of, okay, so I had two choices. I could either move to where it grows. I got my crop that I'm really good at growing. I'm either going to have to move to somewhere where it grows, or I'm here and I own this piece of dirt, and I got to find out what grows here. So I start changing my crops, right?
Mm-hmm.
So that makes crops localized. In other words, I have this one specific to this area, this one specific to this area. So now I'm in Congress. Okay, what? Now let's go swimming. Okay? We're going to go swimming. We are going to go just out here. We're going to go in the Columbia and all this. What are we swimming with?
A wetsuit, probably.
We're freezing our butts off, and thank you. That was an important part. What is the Columbia?
It's salmon.
No. Let's go back. What is the Columbia? Let's say what is the Columbia?
It's a river.
Iceberg.
Almost. Garrett almost said it. Combined your two things, Sheila and Garrett.
Glacier?
It's melt.
It is mountain runoff.
There's a Columbia Glacier up in the Canadian Rockies. I've been there.
The Columbia.
That's where the Columbia River comes from. So
the whole Columbia is mountain runoff. Yeah. What it is it is snow melt. In other words, each winter, Mount Hood and Mount St. Helens and the Toutle River, the Columbia River, and all start pouring into the same spot, basically. But what happens is Mount Hood is sitting up here with tons of snow. And then it starts to melt. And it melts, and as it evaporates, it starts raining down into all of these tributaries, and they all pour, because think about it, where do all of the little rivers lead, basically?
To the sea.
They all lead to the sea, and they all get there by joining together into one big river, which pretty much is the Columbia, which dumps out to the sea.
Yep.
What is important about the Columbia then? And you said it earlier, Sheila.
Salmon.
What? No. What am I wearing?
Oh, it's cold.
Wetsuit.
Thank you. And Garrett, that's why.
Yeah.
The Columbia is just cold. Oh my God.
I wouldn't want to go swimming in there.
Okay. And trust me, I have lots of times. Same thing about the Sandy. Same thing about the Clackamas. Those are all the tributaries basically that lead into the Columbia. All of them are like swimming through ice water.
Mm-hmm.
Okay, so what does that mean? What's it going to have then?
It's going to have a good environment for salmon, I guess.
Aha, yes, thank you. You were just about right on there. It's going to be, what is the Columbia River? It's a fresh water. It's fresh water. It's not salt water. It's fresh water. Cold. It's a major runoff from a rich nutrient environment. It comes from all of the farms, the trees, all that. Remember, we are great big. We're called the Evergreen State for a reason. So we get lots of nutrient runoff to it. So it's nutrient-rich water. So it's going to grow a fish that can survive in cold, that is freshwater, can grow. It's got lots of nutrients. So salmon, steelhead, trout, these things, what happens? They go nuts.
Sturgeon up there into the Columbia Gorge, not way up there, but
yeah, sturgeon.
Out of the ocean too, so you get some fish that coming from the ocean. So.
Now, what's the other thing? Let's go out a little ways, especially for Oregon and Washington and California. Okay, let's go this. Especially Oregon, Washington. Again, the Columbia. What?
Fishing.
No, yeah, fishing, but where?
Huh?
There's a special place. Come on, Garrett. I'm sure you know it. Let's take a ride down the Columbia.
Well, there's a lot of the stuff out by
let's take a ride down the Columbia. What do we hit? It's a special spot. Thank you. What is right there?
Well,
it's called
Stevens.
No, it's called. We go down the Columbia. What do we hit? Remember I said the Columbia is freshwater.
We hit the ocean.
Hit the ocean. What's that called?
Saltwater.
Saltwater.
I know, but there's a special spot.
Where it's part fresh and part salt.
Thank you. It's called the Delta. That is where Astoria is. That is where Oyster Bay is. That is where Oyster City Beach and all
Astoria.
I was going to say oyster.
Thank you. What happens when salt water from the ocean mixes with remember, the Columbia is one big river, okay? There's a reason it's one of the biggest deltas in the world. Okay, there are very few rivers the size of the Columbia pouring into specifically an ocean. There are few rivers that size, okay, with that many gallons of fresh water pouring into a delta right there. So what happens? It dilutes the amount of salt water there, right? You create an environment for a special type of fish. The oysters, the razor clams, the manila, the manila mussels, the clam shells.
Yeah, clam shells, yeah.
How
about crabs?
Crabs, lobster. That particular group loves that environment.
Mm.
So guess what? If that delta ends up, they're perfect right there. We have a unique ecosystem right there where we get tons of it. Oyster Bay is on Long Beach. If anybody,
Long Beach.
Who's driven up Long Beach, baby?
Me.
I lived on Long Beach for about a year and a half. I have a friend who owns a house up there.
I just came last week.
Yep. I have a friend who owns a house in Ocean Park. And I used to, I lived with him for about a year and a half. I was living out there before Shell got here.
My husband go fishing at Long Beach.
Just south of Oyster Bay.
Mm.
And has anybody driven out there, right there by Oyster Bay?
I have.
What do they have there at Oyster Bay that's really cool?
All the shells that are...
The mountains. The mountains of shells, oh my God, they're 50 feet tall. It's like mountains of oyster shells that they have farmed. They've gotten it out of, and it has another unique thing that's really cool. Long Beach, there's a reason, by the way, it's called Long Beach. It is actually the longest beach in the world, the longest single beach. It's 28 miles long or whatever it is. So it is the longest beach actually in the world. It is a peninsula. So guess what it creates? Anybody ever looked at it on a map? It forms Willapa Bay. The whole section for 25 miles on each side is a great big bay between the mainland of Washington and Long Beach on this side. On this side is the actual ocean. Guess what happens in that bay? It becomes an entire oysterville. That's where they get all the oysters from. It basically becomes a 25-mile long delta because the water kind of flows in and out of it and around it, because the Columbia is just on this side and there's a little chunk of land between the two, and basically it flows through little tributaries over to that side and floods it, and it became the perfect spot for oysters to grow. But it did something else. Do you know what it also does? Anybody know what the number one product of Long Beach is? Oysters. Do you know what number 2 is? Special growing. This is what we're talking about. Nope, not even close.
Clams?
Not even close, because you won't believe me that it's not a fish.
It is not a fish.
Okay, what is Long Beach? I just said it's a peninsula, so it's probably kind of
a bird.
No, it's a little soggy there because it's a peninsula. It's only what, 5 miles wide?
Cranberries?
Ah, thank you, Lisa. Got it. Who owns the biggest chunk of Long Beach?
Ocean Spray.
Ocean Spray. Do you know why? Because they have their cranberry farms there. Believe it or not, because of the way Long Beach is in the center of Long Beach, the water has flown over Long Beach, and there is actually lakes up the middle of Long Beach, small lakes. And there's actually a pretty good sized one because it gets wider and narrower and things like that. And there are some lakes up the middle. So it's kind of, if you look at it from the side, it goes like this and like this in the middle. So it kind of sinks down in the middle, and it's got little hills on the bay side, and on the ocean side, it's got little hills. So the water stays over here, and the water stays over here, and the water kind of settles in the middle over time when it gets stormy. So in the middle, it forms a bog. The whole center for 25 miles is kind of a bog. That's where cranberries grow. They grow like crazy. They set in the water, and believe it or not, you know those Ocean Spray commercials? You know they're actually filmed in Long Beach? And the reason is that's the way it is. They walk through the water like that. That's how they farm it. They have entire cranberry farms down there because it's specific to that area. Now, I think I've made it pretty clear some of the differences in farming, right? So here's a major problem. What happens when, for whatever reason, it's stormy? It's really stormy down at the coast. They had probably about 8 years ago. No, it had been longer than that. Oh yeah, it had been 9 years ago. Remember the tsunami in Japan? That's the Pacific Ocean.
Are you thinking saltwater incursion?
Oh, big time. What happens is remember the tsunami in Japan that went over and did the Fukushima reactor and all?
Right.
Yeah.
Well, what most people don't know is I was actually down at Long Beach living there at the time. There was an emergency alert because, remember, that's a tsunami going that way. Well, most people don't realize there was a wave coming this way too.
Yeah, but it was only 12 inches high.
Right, but most people don't realize what 12 inches means. 12 inches is that much. When you are at the coast, 12 inches, this puts it up to basically the road. Okay. They're saying, you know, it was not a big deal. It actually was pretty bad in some of the coves, but not that bad overall. But the worst part was, it was 2 a.m. when our phones started ringing with the emergency 911 dialing, telling us to get out now. But it didn't actually happen as bad as they had. Our version was, we're going to Vancouver just in case. And we did. We just got in the car and we drove to Vancouver because it was just better to be outside of it. But we were in the tsunami zone. This is not the first time this has occurred. What has happened before is several, I can't remember, it was like 2 years after that. Yeah, 2 years after that. There was the equivalent to a storm that came up on the Pacific coast. Now, most people here didn't ever feel it, here in Portland, I mean, because it didn't come inland that far. But when you're on the coast like that, there was basically a hurricane. It was hurricane wind level, and it pushed the ocean, and the amount of rain that fell was over 18 inches of rain pouring down on Long Beach and all that. It flooded large areas and allowed the ocean to actually come up over, and remember I said there's kind of a hill on each side? In a lot of the areas, the storm was so bad, it actually pushed part of the ocean over into this, and remember the bay is on this side. The bay just keeps filling up. It pushed part of the bay water over here, flooding and changing the center of that water. Remember I said Ocean Spray owns all that and has cranberries in there. The bay has Oyster Bay is what it has. It's literally entire oyster farms. The entire front is all clams and things like that. The storm was so bad, it disrupted how many were there. It disrupted the actual environments to where they died. Okay, it destroyed a lot of the crops. Luckily, when it happened, it was towards the fall, where most of the crops had already started to be harvested and the seasons were over. So it didn't affect that season as badly as it could have, but it did destroy a lot of the crops. This actually caused several of the farmers, particularly the oyster farmers, who got hit the worst. The ones who fished and got the oyster shells. And it also affected some of the logging along that. There's a lot of trees and timber farms along that edge of the bay. They were destroyed. They were flooded out, and the trees, it's mainly sand there. So because it was flooded, and the wind was so bad, it literally blew the trees down. These people are farmers. They're small farmers, things like that. This destroyed them. Okay, they were going out of business as a result of it. So what happened is they put in place, they became an emergency, they were able to get special benefits from the government, which allowed them as a farm to declare those lost crops. Now here's the important part. Lost crops are considered deductible, okay, for a farm. They are given tax breaks and actually tax incentives. Now, this is what's bad. You've heard about people who just say, you know, well, yeah, these places are just leaving these crops in the field to die. Well, it usually doesn't occur too much in regards to smaller farms because the farm itself would go out of business. Sometimes the bigger companies can leave some to, in a sense, die. Usually it's not for that reason. Usually it's to re-fertilize the ground because most people don't understand farming in that sense. They'll leave it for a year to not actually grow. They don't plant it. Instead, what they do is they just leave it what's called fallow, so it can just kind of grow and refertilize itself for a year, so it replenishes the soil, and they leave areas that grow up and go down. Now, here's the important part. Okay, I'm a farmer. Part of my farm requires me to be working my farm, right? I've got this field that I've farmed for so long that the dirt is basically dead. Okay, what does that mean? Dead dirt when I say that.
It won't produce anything.
And usually that's because why?
Bad farming methods.
Well, it's usually because there's no nutrients left in the field. That's why we use fertilizer.
That's why you do crop rotation.
There you go. Thank you. Thank you, Sheila. That was perfect. Now, what happens when I'm doing crop rotation and I'm in business and I'm doing crop rotation and I've got that field sitting there and I'm not using it because I can't grow anything on it this year. I don't have any profit from it.
You get some kind of compensation from the government for not farming that particular field.
Thank you. You have basically, it's considered an expense for you, for your farmers and fishermen. It's an expense for you when you have to leave a field unused because you have to do it. You can't just say, well, I got to use it. It's not going to grow anything, guys. We know that. All right. So we have to leave it empty and we have to fertilize it and let it set. We have to rotate our crops because if we don't, we've learned this over hundreds of years. If we don't, that crop we try to produce is only going to damage the field worse. Okay. It's going to make it even worse than it was. We have to rotate the crops and make them so that they can actually produce again. So we do this and we're leaving a field non-productive. Well, that's killing my business. So I get to take that as a write-off. Everything that would have been produced, I have to take it as a write-off. It's killing me. So I get basically for that year that it's down, as long as I'm keeping track of it. Now again, this is the important part, and this is only for farmers and fishermen. There are a number of circumstances that happens to them. They have to do things like farm rotation, okay? Crop rotation has to occur. They have to plant this field, leave this field bare. Plant this field, leave this field bare. They have to shift them because if they don't, their crops will never be produced in all their fields. So those fields that are not in use, they would go under if it weren't for some type of stipend from the government saying, I'm leaving this field empty, I need something for it. So the government says, okay. They made an arrangement for it, for farmers only, okay, for people who are doing farming, timber, livestock, dairy, that sort of thing. All right. Now the other one is, like I said, disaster strikes, the flooding occurs. Oh my God, we have no crop. For that year, I'm out of business. I'm dead. I don't have anything. You know, what happened? Okay, let's talk about wildfires. Remember the Eagle Creek fire, which some kids throwing fireworks into trees?
Mm-hmm.
How many acres? $64 million worth of damage? Okay, how many acres of trees were burned? How many houses were burned? How many, you know? That burns down farms, that burns down crops, that burns down people's lives. Now, oddly enough, that actually helps if you can get something for it, you know, insurance or whatever it may be, because the ash actually helps fertilize the ground, but most people don't realize that. But, you know, hey, that's why after a fire, things grow better.
And then you get morels.
You know, but, so, let's think about that. You've got a fire, natural disaster, whatever happens. In this case, let's just say a lightning bolt starts a fire instead of some idiot kids. Lightning bolt starts a fire and starts burning your crops. You know, your insurance doesn't typically cover, by the way, natural disasters. You ever looked at your insurance?
Crop insurance does.
There you go. You got to have a special insurance for it. Crop insurance. You have to have special considerations for it. You have to have things which cover your potential loss. All these deal with farms and fishermen. And who knows of the fish? Here's the other one. What happens when you got this big company that comes through? Because what's neat about the Columbia? You're a fisherman. What's neat about the Columbia?
Got lots of fish.
But what's on the other side? What can fish the Columbia?
Small boats.
Small boats and
Commercial ones.
Commercial.
Thank you. Can those small boats compete against those great big commercial fishermen?
No.
So what happens when a whole bunch of those great big commercial fishermen go through there and just grab up everything?
They're out of business.
Wipes
Exactly.
out the stock.
So they have special laws which say when they can fish and where they can fish, and based upon your size, what permits you can have. And that also includes what happens if this year you don't get any fish for whatever reason. You're out there fishing, and you can show you were out there fishing, and you're not catching anything. They have special considerations for that, okay, because it does happen.
Use
And the
income
government.
averaging for farmers and fishermen, isn't that right? Over
Yep.
what, 3-year period, isn't it?
Yep. They consider what you have made in the past. They consider what you have shown as your production. And what they do is they try to equal it out because they realize something may have happened. And they know that it's not your fault necessarily. You were just a victim. And here's the important part. If this was any other type of business, would they bail them out? Well, except for the auto industry. We won't go there. You know.
Not
Yeah,
banking either.
And
Usually-
banks, yeah, they bailed out.
Or banks. I'm sorry. I forgot the banks and credit unions and stuff like that. And so, but a normal business, would the government come in there and say, oh my God, you need to stay in business? Normally they'd say what? Thank you for playing.
Yep.
You know, it's like, but
We'll take
why?
that.
You know, it's like game over. What would they say? Why do they, to the farmer, say, let me help you?
Because they got to keep them in business, keep them producing stuff for the
Because the following year they're going to die without lobster. You know, it's like, it's true. They want lobster. Okay. They need to have them in the following year, even though that year they didn't produce as much. The following year, its odds are they will, because they have a history of it. So what they do is then they keep them alive for that year that they weren't able to produce, because they know that people will need food next year. The need for food doesn't go away. Okay. The need for cars, even though they bailed them out, is not necessarily a need for cars. Okay, it's a want for cars. Okay, the want for Teslas or the want for whatever is a want. There is a need for food. We die without food. Okay, so the government knows that. So they go out of their way to supplement that, because they know that without that fishing industry, our salmon go away. Without the crop industry, we don't have apples. Okay, so they have to, but what happens if there's a terrible freeze along the Columbia for whatever reason? It freezes really bad a winter. We've had anybody lived through a silver thaw? Trust me, I know what a silver thaw is. Okay, anybody know what a silver thaw is?
Nope.
Who here in Oregon has
I don't
actually lived here for probably more than 30 years?
I was born here, so
Okay, Garrett, you should know what a silver thaw is. Oregon does what during the winter? During a real winter. Let's not talk about the ones where it snowed on Wednesday last year. Okay. During a real winter, what does it do?
Well, the Willamette used to
rains and it snows.
people would ice skate on it.
There you go. But here, Garrett kind of said it. What did you say?
It rains and it snows.
It rains and it snows. Why does it rain and snow?
Because it's cold, it's mountain
Temperate.
area.
Aha, almost. I heard it. Sheila, what did you say?
Temperate. It's a temperate
What ends up
climate.
happening is Oregon is right there. In other words, what it means is its temperature is right at the freezing point. So what happens is it warms up during the day and everything melts, or it starts to melt. At night, it drops down cold, okay? And what ends up happening is it turns, those pretty icicles? They look so pretty on all those power lines and over all the fir trees and over every street and over everything, including all the plants, and especially when it starts getting thicker and thicker. And then what's really cool is when I was probably 8, something like that, I would sit out on the deck of my house, because it's up in Happy Valley, up on the hill, and we would watch those pretty blue flashes. They would be like the coolest little explosions. When the power lines would fall because of the ice, it would go, and we'd see them off in the distance, and it was the coolest thing you'd see. And it would kind of dance for a little bit, and go, and then it would go out when the power goes out, and then it would go over in another area. It was the coolest thing you ever saw. And we thought it was neat, except our power would be out for weeks. But, that's a silver thaw. What ends up happening is a true silver thaw means that during the day, it starts to warm up just above freezing. All right? So that top layer of ice and snow, typically, the snow will melt right away, and it starts to turn to water, and by the time it gets melted, it's starting to get dark. And that just turned to water has not run off yet, because it's starting to freeze already. Okay, and it's running over ice from the night before. So it freezes and builds a little more layer of ice, and builds another layer of ice, and builds another layer. By the time...
Black ice.
Well, much worse than black ice. It makes what are called... These things are really interesting. They're called widowmakers. Does anybody know what a widowmaker is?
Usually a tree that's going to fall on you.
Thank you. She got it, Sheila. Man, you are brilliant, Sheila. You know that? A widowmaker is actually named after those big-ass branches up there, way up there, that are covered in ice. And the tree can no longer support them. And they're called a widowmaker because as you walk under, you'll hear them pop. You'd hear them, a long ways away, you hear this, and one fell. And the whole branch, and it could be a 30-foot long, it could be some big branches. These are the big ones from fir trees. Sometimes the whole top of the tree will fall, all covered in ice. Do you know how many tons of ice that is falling? It hurts. You probably would never feel it. It will just crush cars, power lines, houses, you name it. And what happens is it starts to build up where the temperature can no longer overcome it. So in other words, it doesn't melt enough to actually wipe it out during the day, and it just starts building up. And when I was younger, and it was really cool because we had a really long driveway. Our driveway was about 1/4 of a mile long, all downhill. It was rock, so it had kind of like 2 divots in it where the tires would go. Now, imagine those covered in ice. Do you know what snow discs do on that? Because we aren't going to school. We aren't going to school. There's no way we're going to school. You get a snow disc on that, you have to roll off of it because there's no other way to stop. We'd have to roll off into the ditch and hope we didn't die. We were insane, but it was great. You'd get up to speeds you wouldn't believe going over that sheet of ice. But what does it do to the crops? Because that kind of ice, when it gets to that point where it's a silver thaw, a real silver thaw, and by the way, yes, you are right. They have driven across the Columbia and the Willamette before. My grandfather used to talk about driving across the Columbia. What happens when it gets that cold? When does the growing season
freeze?
What does it
kills all the insects and the bugs?
There you go. That's one positive thought, and but it actually it's a bad thought because then it doesn't pollinate. But here's an even worse thought. What does it do to the growing season?
Shortens.
It destroys the hazelnut tree season.
There you go. It starts to kill it. It basically wipes out the growing season. An entire area, an entire industry could be wiped out. With a silver thaw, you're not talking about just a little problem. You're talking about the apple trees just went, the cherry trees just went, the hazelnuts just went, the filberts just went. Strawberries, I'm sorry, I totally forgot about the strawberries, are gone. Blackberries are history. Blueberries can go on vacation for a while. What else did I forget? Since I just wiped those out. The fish will actually be lesser because they don't have the early spring to spawn as much. So our fishing industry just took a dump. So one silver thaw does what to the Pacific Northwest? Not just the power lines, which are really cool. Like I said, you watch that blue flash in the distance, man, it's neat. Not just that, but what does it do to the entire industry afterwards?
Destroyed it for that year.
Negative impact on it.
For a long time. That aftermath is, that whole next year is going to be a problem. That's why even on the tax form, now here's the one thing that you have to consider. On the tax form, just for farmers, what do they have? This is an important thing.
Income averaging.
Nope, on the tax form itself, what does it have? Just for farmers.
Crop loss?
Schedule F.
Oh, yeah.
They created on the 1040 is a special tax form, the special schedule, just for farmers. It's the profit and loss because they know that farming is so unique and so necessary that there is an entire separate schedule just for farmers, a Schedule F. All of their income and loss is reported on a Schedule F. It's the only one that gets that special one in that sense. You know, most of them have a separate form, you know, the 1065 or the you know, a 1120, you know, they have their own tax form entirely. But farmers, they were given their own special schedule just on the 1040, just because it's them, just because of how important they are in that sense. And most people don't think that farmers are that important, but over the years, we've discovered that they are. So all of their, yeah, you want to, thank you. Garrett, you said it perfectly. We know that without farmers, we don't eat. Okay, so they created a special form just for farmers. All right. Now, does that kind of have you understand that farmers, it's a 1040, okay? There's nothing special about it in that sense. It is a sole proprietorship, basically. Okay, but all of the reporting of the profit and loss goes on the Schedule F. Okay, because they have special calculations for them. That is the only difference, because they have an entire set of special conditions for them. And each state even has special considerations for them because they know how important they are and how specific they are. Okay, but for farmers, really, that's what you need to know. They use the Schedule F, they use the Schedule SE for self-employment, and that because of their crop production, what they produce, crop, timber, livestock, orchards, dairy, fishing, and that it's localized and specific, that they get this consideration, and that it's based on natural disasters and the need for their product. Okay, that's the only thing. And now you guys understand more probably about fishing and farmers than you ever needed to. I grew up on a farm, so that's why I understand. Okay, that's having grown up there, that's why I got it. I had my cows, I had pigs, I had horses, I had gardening, you know, you name it. So, all right. Does that make farming and fishing clear? At least a little bit as to what it is?
Yes.
So, and why they exist? I mean, the biggest thing is why they exist. Not a matter of what, you don't need to know the special considerations they get. You just need to know that they get special, the only thing is they do, and this is probably the most important one, they do get to deduct a higher percentage of their mileage expenses than other businesses. I think it's at 0.62. I have to look it up. I can't remember. But they do get a higher percentage of mileage expenses than other businesses because of the amount of transportation they have to do. Okay. And then they get special consideration when disaster strikes. That's the two biggest things. All right. Let's go to the very last one. Sheila, you brought it up.
Nonprofit?
Nonprofits. Thank you. Anybody want to take maybe a 5-minute break and we'll get into it quick, or you want to just keep going? Okay, let's take a 5-minute break. All right?
All right.
Okay, that's terrible. I really got to teach that Keurig to already be turned on and waiting for me when I'm taking breaks. Oh, needs to learn these things. My coffee maker needs to understand that it needs to be ready for me when I need it, not when it's convenient for it.
Okay, I'm back.
I'm back.
Hey, dear. Hey, guys.
Sorry about your coffee.
God, no, it's like, you know, you got to wait on the Keurig to heat up. I hate that. It's supposed to know that I'm coming for break now. You need to be on and waiting for me. You know, it's supposed to understand these things. You know, it's just one of those things. My Keurig is supposed to think for itself. Of course, if my Keurig ever really did start to think for itself, I'd probably be scared. But, you know, hey, you know. All right, let's give him a minute. Noemi, you there?
Yes.
Okay, dear Lisa, you back?
I'm back.
Hey there, sweetie. Okay, we're good. All right. For our last part is the fun one. I've actually set up a bunch of these. Having dealt with the church for years, I've had to set up. I'm always the person who has to set up the entity. So I've had to set up a bunch of these. Nonprofits. Okay, let's think. First question. Let's make sure. Oh, yep, we are recording still. I recorded during the break. Well, good. So we got a break recorded in there too. So we're good. First question. And we're going to stop this sharing here. There we go. And we're going to go back to this. All right. Trivia question for the day. What is a nonprofit outside of a church?
Charity?
Well, that's one. There you go. A charity. What else? It's another good example here coming up. What are we doing right now? What are we sitting in right now?
Class.
And? What's a nonprofit?
School.
Thank you. There are three things that are nonprofits, and that is it. There are no other nonprofits in existence. Sorry, Frank, we'll talk when I'm done. There are three things in existence, and that's all that can be a nonprofit. They're operated exclusively for one of three reasons. They are either religious purposes, charitable purposes, or educational purposes. That's it. They cannot be used for anything else. Okay, and that is what the distinguishing characteristic is for a nonprofit. All right, it actually specifies this. There's an IRS code. It's the 501c area. You always heard of the famous, are you a 501c3 charity? Okay, that's the kind of charity that is allowable to, the printer's still down at Stark, unbelievable. The 501c3 is the kind of charity that anyone can give money into, and its entire purpose is for non-profit. In other words, no support of someone. In other words, it is tax deductible. All of your donations, goodwill. Okay, they are giving it freely for somebody else to use. Your donations to the church. Most churches are, by default, they are a tax deductible entity. Schools, usually private schools, if you think about it that way, are considered a tax-deductible entity, a nonprofit. So any donations you make to them are considered tax-deductible. Any things like the I'm drawing a blank, support the children overseas, even anything like that, where the organizations are supporting children, supporting schools, supporting youth groups, boys and girls clubs. That was a big one.
Were you thinking of NGOs?
Yes. NGOs. Anything where it's not, and here's the condition, and this is probably the most telling way to determine if it actually qualifies or not. The shareholders of a nonprofit get nothing. They cannot profit from the organization in any way. What that means is they are not allowed to have any taking, in a sense, from the company outside of a regular salary. That's the one thing they can do. Now, understand something. When I say that it's a nonprofit organization, there's always somebody who goes, doesn't the owner of Goodwill make about $2 million a year? The owner of Goodwill does make about $2 million a year. He makes it because he doesn't get a draw. He actually gets a salary for being the president of Goodwill. In other words, by representing Goodwill, he gets a salary. He actually gets a regular W-2 at the end of the year, and he has to report it on his taxes. It's not a dividend or something like that. He's not getting as a profit. He gets a regular paycheck. Some people go, is $2 million an exorbitant paycheck? Well, that's kind of a matter of conjecture. Okay. If you think it is, that's a matter of opinion. Okay. So you can't say one way or the other. But in the end, that balance sheet has to equal zero. In other words, when you do those assets and liabilities, the final outcome at the end has to total zero. In other words, all of your liabilities you had that year and all of the assets you had that year have to equal zero. That makes it a nonprofit. Mm-hmm. Now, what that means is it can only be for charitable purposes, educational purposes, or religious purposes. Okay. It has to meet those two major criteria. All right. If it doesn't, it immediately is not considered a nonprofit. It has to either be a charity, educational, or religious, and at the end of the year, its balance sheet has to be zero. I guess there's actually the third one is, like I said, the shareholders, the people who basically run or own the company, have to get nothing from it. It cannot benefit any private shareholder or individual. Now, that being said, nonprofits can be created as different entities. So if you create it, let's say you're starting a school, okay? A school can be started as a corporation. It can be started as a trust. It can be started as an unincorporated association. In other words, people just get together and it just starts to form. Then it's just an organization is what it's considered. We'll get into that a little bit because a lot of that are things like, I'm trying to think of what would be a good example of an association.
Homeowners association?
A homeowners association is. That's actually a good group that gets together. They have a legal representation because they're all together. They have an interest in what's going on, and they're not officially incorporated. Okay, so yes, that is a good one. Another one is often, and it depends on how you view it, it's a labor union. Unions are people who come together with a common interest, form their labor union to represent themselves to business. Okay, so it's an unincorporated association. ARP, there you go. AARP, the Association of Retired Persons. Okay, whole bunch of people over the age of, believe it or not, now they're down to 50. If you're 50 or above, pretty much you can become a member of AARP. And they come together, and because of their size, that's a whole lot of representation power. That's an unincorporated association. Now, the thing is, how is it working, and what is it working for? Let's say I get together and we are trying to, a disaster happens, okay? And by that I mean Katrina hit. When Katrina hit, people came together as groups and collected funds. Okay, they had special Katrina charity organizations that formed as a result of it to try to bring funds into the victims of Katrina. Okay, so they were formed as an unincorporated association. People just came together. And what ended up happening is they were a charity. Now, at the end of the day, if one of those people intentionally started to do this to make money out of it, it's no longer a nonprofit. Okay, because some of the people who did this saw an opportunity, and they tried to pass themselves off as charities when they were getting money out of it. Okay, that's a no-no. Okay, that means you are no longer a nonprofit. When you form a nonprofit, to do so, churches by default, as soon as you come together and you form a church, this includes synagogues, temples, mosques, whatever religious organization, I just say churches, okay, as soon as they are formed, whether they have an actual building or just a group coming together, as soon as you basically name yourself as a church, you do not have to apply for anything. You are immediately a tax-exempt organization. That's the only exception to this. You immediately, by default, become a tax-exempt organization as soon as you're a church, okay? The others, like a charitable organization, one that is trying to get funds to feed the children or save the whales or whatever it may be, has to file a form with the IRS, and it's the form 1023. And what it does is it allows them to become and be recognized as an exempt corporation, as an exempt entity. Okay, how that entity is formed is up to the thing. Now remember, there are two types of entities which can never, ever, ever be a nonprofit. You know what kind they are? Can you imagine two types of entities which can never be a nonprofit? And think about why. What does a corporation have?
Profit.
Okay. Where are those profits shown?
On the
income statement.
on the income statement, yeah.
Okay, let me put it this way. Let me change that just a little bit. Let me change that just a little bit. What is one of the very first rules of business? Never, ever commingle your personal money with your business money. Period. That is one of the most important, when we get into the business functioning, the very first rule, rule number 1, and I'll probably tattoo it on your foreheads, is you never commingle funds, ever.
You
And it's
don't need
probably,
to.
and
I've
it's
already tattooed it on my client's forehead.
there you go. Because honest to God, you wouldn't believe how many people are just by nature, oh my God, they do it. They start a business and they start running it through their bank account. They start running it through whatever. What does that do?
Well, muddies the water between you and your business.
Thank you. It muddies the water. So with that in mind, what are 2 types of businesses which we said this is really strict because it's exempt? Okay, this is exempt money. So the government is really strict about it because you're not getting any tax money on it. So they're kind of looking at it going, you're not paying taxes. That's fine. You better prove it if I come to you. So with that, what are 2 types of businesses which can never, ever be a nonprofit?
Churches and 501(c)(3)s.
No. They're both nonprofits, but what are 2 types of businesses? So we've got C Corps, S Corps.
Oh, okay.
Sole proprietor.
Personal Services Corp.
No, you're almost there. Let's go back to the 4 basics.
Sole proprietorship.
That's one of them.
Partnership.
That's the other one. Why? Why would you never, ever, why would the IRS say, no way are we going to ever let you have a sole proprietorship as a business, as a nonprofit? Nonprofit can never be a sole proprietorship.
Because it's a sole proprietorship is using the Social Security number.
There you go. Thank you. What does a partnership use?
Use a Social Security number
Security
or
number.
EIN.
Yep. An EIN, it's no longer a partnership, remember? If it has an EIN number, it becomes an LLC.
Yeah.
Still a partnership, isn't it? I mean, it's an
Well,
LLC, but it's
it is a partnership structure, but it's no longer a partnership. It's an LLC.
okay.
So those 2 can never be nonprofits. Ever, because they're under your Social Security number. And that means all the funds are going through you, basically, in a sense.
Yep.
And they're all under your Social Security number. And commingling that thing, you're commingling charity funds. You know, in that sense.
No.
No. So they go, the 2 that will never be nonprofits, partnerships and sole proprietorships, cannot be nonprofits. They can be associations. They can be trusts. They can be corporations. Okay. They can just be a church, which doesn't even have to become one. They're just basically an association in that sense. Okay. But they can never be a partnership and they can never be a sole proprietorship. So now, what are some of the activities of a nonprofit that may be questionable? Why would all of a sudden this corporation, this nonprofit, they would start looking at it going, hey, you know what? You're looking a little like a business. What would some of those things be?
Employees.
No. You can have a nonprofit with employees.
You can have a nonprofit with employees, but
Manufacture something?
Selling activities.
Not the income you have flowing through your nonprofit.
that would probably be one of the biggest ones. Where is the income coming from? By the activities. What ends up happening is what determines if you're a nonprofit. If you're holding a bake sale, that's one thing. But what happens, you know, there are churches now, Mount Tabor Presbyterian has a coffee shop in part of the church. Okay. So wait a minute. Are you a church? Or are you a coffee shop?
Or den of iniquity.
Well, if the coffee shop, okay, so if the coffee shop, all the profits went to the church, then like
you're starting to catch on.
Your sales that you do for your church. I mean, they have a
you're
craft
starting to catch
fair.
on.
All the profits go to the church. So the profits can't go to the coffee shop. The profits would have to go to the church.
Very good. It has to work as a fundraiser. In other words, all of the proceeds have to go to benefit the church. If the proceeds benefit anyone else, then it's no longer a nonprofit. And that can affect that section. Now you can spin that off. Remember, that coffee shop is still a coffee shop. If you take it and turn it into an LLC or something owned by the church can own stuff. You know, the Vatican owns more property. It's the largest property real estate holder in the world. Okay, the Vatican. Last time I checked, that's a pretty big church. So it can own property. It can own things. Okay, it's all owned by the church as long as its activity is to benefit and go solely to the church. There it can be given out, and here's the important part. It has two different types of expenses. It has two different, expenses are the wrong way to put it. It has two different ways that the money can go out of the church. Okay? We know how money can come in. It can come in through fundraising, through activities as fundraising, bake sales, coffee shop, whatever it is, the money can come into the church. Donations, that can come into the church. How, and here's the important one, how can it go out?
Expenses and payroll.
Expenses and gifts. Okay. Payroll is part of your expenses.
Oh, okay.
Gifts are charitable donations. In other words, I have money. I am a church. Okay. I can have expenses for the people who work for the church, the people who service the church, for the church materials, for the books, for the people working in the church. I can pay people to actually work in the church. Now, clergy, and we know this, clergy have special considerations. We pay clergy.
Yes.
Okay, clergy receive payroll. Okay, we can give them money. We do. They work for the church. Okay, they don't just volunteer their services. Now, they do in many cases. Pastors dedicate their time to it. They actually donate their time to it. But in a lot of cases, pastors, priests, and they actually work for the church, and they get a salary, and that's how they support their families. Okay, they have to. If I was just a pastor and I'm donating my time to the church, I got to work full time to support my family. Okay, but there are a lot of people who are full-time pastors. Their salary is being a pastor, so the church pays them a salary. Okay, now here's the important one. Who controls the salary?
The church does.
Church body.
The church body does. They are truly, when it comes down to it, they are the shareholders. Okay? The church body are the shareholders. Now, the pastor can be a member of the church body too, by the way. But they cannot individually just say, all of those funds are going to be my salary. Okay? Because they're an association. They are not officially incorporated in that sense. Even if they incorporate, who becomes the members of a corporation if a church incorporates?
Board of directors.
Board.
Well, it goes a little bit farther than that, because who are the shareholders?
And
The body is still the shareholders. All the members of a church are officially the shareholders of the church. Everybody who donates, in other words, is technically a shareholder of the church. And seeing there are no records really of donations in that sense, you know, some churches do record every donation. A lot of them do not. When you pass a donation plate, do you record everybody who made a donation? No.
can't really record those who donate cash. So
Exactly. So as a result, the church has shareholders, all of the body, who get to vote on all that's going on. Usually it's all the members of the church that are recorded with the church in a sense. Okay, in other words, you've registered as being a member of the church. Okay, that's the one step that's kind of like, it's kind of up in the air and it's kind of based on your church, but it's not, remember, these are not really strictly enforced. But your church body are the shareholders and they are the votes. Now, sometimes there is, if the church is large enough, it has its own council or the elders, depending on how your church is structured, and they will vote on day-to-day activities and that sort of thing. But what ends up happening is anytime it involves something which affects these guys, guess who has to vote on it?
The church body.
The church body. They cannot, you cannot decide something on your own. In other words, I can't say that, you know, I'd really like a $10,000 a month salary. Sounds good. Okay. They can't do that. They can't vote on something which affects themselves in that sense. Okay. They have to only vote on things that affect the church itself, or the church body has to vote on it. Okay. Now, nonprofits. Let's talk about something that's outside of the church. The schools. Okay, because there's really three main types of nonprofits. Okay. The schools, the charities, and the churches. Churches are pretty simple. They are formed by an association that comes together, and they kind of set their rules, and they are formed when they come together. All right, they don't actually have to physically file anything. Now let's talk about the ones that do have to file something. All right, Katrina happened, I want to start something. All right, so what do? I have to form a business. So what I do is now I have two things to file. All right, first thing I file with the state. I file to incorporate or to form a trust, all right, or just a group of us come together as an association, however it may be, but I'm going to form some form of body, right? So if I'm going to, let's ignore the unincorporated associations because that's typically a church, all right? A nonprofit organization or corporation usually has to file with the state. All right. So let's go this way. I'm going to file with the state first, and it's a special form because it's not like a normal C Corp. It is a C Corp for a nonprofit, or it is a, now, what will it not be? It will not be an S Corp, will it? Normally, it will not be an S Corp. I mean, it could in extreme cases because of tax issues if one corporation owns another corporation. One nonprofit technically owns another nonprofit. But you're going to get looked at really strongly. Okay, trust me in that case. If you try to form a nonprofit S corp, they're going to look at that because immediately you're trying to pass funds around. Okay, because that's the main reason for an S corp. So most of them would be a trust or a C corp. Okay, trusts are often charities, and we will get into trusts a little bit. So let's just focus on the corporations. Okay, so it's a C corp nonprofit. So you file with the state, and then you file with the IRS. And you file two things with the IRS. One, you get an EIN number. You still need an EIN number because you need to identify who you are. That's the companies, the nonprofits, and it's an EIN. It's a regular one, but it says specifically for a nonprofit. Okay, you identify it as for a nonprofit. Now, you are not given tax exempt status yet. Okay, understand that. You are given an EIN number from the IRS, but it is not necessarily a tax exempt status yet. There's a second form that has to be filed and reviewed. That is the Form 1023. That's the application for recognition of exemption. And what it means is you have to specify what you are going to be doing. I'm going to be a charity for the National Federation of the Blind kind of thing. I have a friend who's a member of it. I'm going to be a charity raising funds for orphans in the Philippines, or I'm going to be, whatever it may be. And you have to specify these things, what your function is, what your means of raising. Are you going to be doing primarily fundraising? Are you going to be doing primarily donations? Are you going to be a combination of them? And you need to specify this. Okay, once you have done so, you need to file that. And once it's filed, then the IRS will determine if you actually have tax exempt status. Now, again, like I said, the church, because it's a religious organization, a church, a synagogue, a temple, they actually don't have to make this application. This is only for the charities and the educational services. The churches get it by default. Okay. These charities and these nonprofit schools have to apply to make sure that they're able to get the tax exempt designation. All right, and you have to specify specifically what it's for. Now, once that's then approved by the IRS, then yes, you are a tax exempt organization. And then you end up with the 501c3 status. By the way, you have to prove a couple of things when you do this. And no, it is not free. That tax exempt thing? Yeah, no, it's like $400 just to apply. So you do have to specify things. You have certain dollar amounts that it has to be in donations that you will be expecting and that sort of thing. And that's what it's determined on. So yes, it does take a little bit to apply for it. Now, how does that affect you when you're doing your taxes? When you are doing your taxes, and how do you get money out? All money, as I said, has to be coming in donations, coming in from fundraising, coming in from your actions. Okay. Going out can only be two ways: expenses and donations out. In other words, you are giving money out to the people you were trying to help. Now, that can either be in the form of material stuff that you typically have and you can show as an expense that you've purchased for them, or direct funds going out. When you do this now, the expense part is kind of an open end. Okay, by open end, I mean this. salaries, outside marketing, fundraising activities, all these are expenses. Now, what that means is you have to account for them. So you are going to have a fundraiser. You are trying to get funds for another church, for a group that is in need of food and supplies in Mexico, who knows, okay? Now, when you do this, you hold a fundraiser. Now, there are expenses for the fundraiser. There are expenses for the marketing of it. There are expenses for the processing of the funds, believe it or not, because you have people who have to take the money in. You have people who have to work to process it. You have to have people who, if it's food you're purchasing, you have to have people who purchase the food and stuff that then ship it over to that country and then distribute it to the people who need it. Those are all expenses. On that balance sheet, out of your donations, let's say you took in $1 million. Okay? At the end of the day, you may end up with $8 million in food and medical supplies that you buy, 200,000 in marketing, 400,000 in fundraising, 400,000 in purchasing, and $1 million in not $1 million, $100,000 in distribution. Okay, if you add that up, if I did my math right, that should total $1 million. Okay. Now, you took in $1 million, you had $1 million in expenses and things you donated. $800,000 of that was the actual donation. You paid this marketing firm, you paid this organization firm, you paid this accounting firm, you paid this distribution firm, okay, all of their fees to do their jobs. Now, you will have, and it's based upon how you are structured. If you are a corporation, a C Corp, you would provide and it's basically a charity. The form is a 990 return of organization exempt income from tax. Okay. And on it, it's a form 990. It shows the information. It's not, now remember, this is not the same as a regular tax return. You're not filing, an 1120 tax return. You're filing a 990, which is showing it's for charities only. And it says, this is what I took in. This is how it was distributed and spent. Now, it is for reporting only. Okay, because remember, there's supposed to be no profit from this. There's not supposed to be any balance at the end of the day. Okay, there's supposed to be zero. So what happens is that gets reviewed by the IRS to make sure that those expenses you put in there, that none of them are specifically for profit of any of the shareholders. Okay. Now you can pay people in your congregation to work for you. You can pay people to do tasks. You can pay things like that. Okay, I'm not saying you can't do that, but they will flag it if suddenly one of your board members or one of your, let's say the wife of one of your board members suddenly has a salary for doing marketing for $100,000 and your total was $1 million for the year. They're going to go, she has $100,000 salary, you're a charity, and she has $100,000 from marketing. Okay, that will be a red flag for it. So on the form 990, it is primarily for the IRS to look at, to make sure you're acting within the guidelines of the IRS for its non-profit status. Okay. It's not looking at it to say you owe this much, or there's no on it. There's no refund or payment. There is just what was taken in and what was paid out. It's basically a profit and loss statement. That was interesting. It's a profit and loss statement for a business. Okay. And it is how the nonprofit shows that its funds were used for nonprofit activities. That's really all you need to know for you need to know the two primary, the IRS code. The IRS code is the 501c, and that is where all of the charity information resides, which is, like I said, the most famous one is the 501c3, where that's the charity allowing you to be a tax-exempt organization. And that's where you hear, I'm a 501c3. The form itself is a 1023. Okay, that's where you have to file. That's what you have to file for the exemption. And then the form 990. And that is the tax return that you have to file. And it's called a tax report, actually. It's not a tax return. It's just a tax report, so that they know that you are reporting your income tax, the exempt income tax, so that they know that they're not going to be taxing you for it, because they can see what was come in should be the same as what goes out. And with it, again, remember something. Bank accounts are assets. So when I talk about, there's an important thing, okay? When I say what came in and what went out, means that the assets equal the liabilities. Okay, so at the end of the day, don't panic when it says, well, they had $10,000 in their bank account. Isn't that a profit for them? No, it's not. That is their cash asset, is what it's considered in a nonprofit. Okay, it's not going to anyone. It's still part of the nonprofit itself. Okay, it's just an asset. It's a cash asset. It does exist as an asset. On the other side, because that's income, it's going to show as an asset for you to compensate for that income. Okay, so you understand that one. All right. So existing things does not mean that a nonprofit will not have bank accounts and have cash on hand. It doesn't mean they have to go out at the end of the year on December 31st and go, oh my God, I've got $100,000 in this account. We've got like 3 hours to spend it. I can see this. I can see somebody out there. This would be great. Could you see all the nonprofits on December 31st? I can see them out there going, quick, here, this is for you. Like, just write me a receipt.
Brian, I've got a question for you.
Yeah.
When you said the balance sheet has to equal 0, do you mean the balance sheet on a particular activity? Because obviously these charitable organizations are going to have assets and liabilities that are going to equal more than 0.
Right, and that's what I'm saying is, at the end, when I say the balance sheet, I'm just saying basically when they get done at the end of the day, what they took in has to be accounted for.
Okay, because a balance sheet would be,
right.
Yeah.
Right.
Different.
Yeah, they can be different, but what I'm saying is, at the end of the day, at the end of the tax year, you have to be able to account for everything that came in and everything that went out. And that's really what you're doing.
So what you're saying is the P&L should be 0.
The profit and loss should be 0, yes. The P&L should be 0.
Okay.
So, you're not looking for you want to make sure that people are not taking cash out of a nonprofit for themselves.
Got it.
So that is the biggest thing about the nonprofit. The other two is the important thing is the three things that it can only be. It can only be a charity, an educational institution, some from school, whatever, and a religious organization. That's it. No, there's the only thing. They won't allow anything else. And that sole proprietorships and partnerships cannot be a nonprofit. So, and then again, like I said, the most important one is no private individual or shareholder can benefit from it. Those things, if you've got that down, you know everything you need to know about a nonprofit. You know the form, you know it's a regular, you have to file the 1023 to apply for it. Churches are it by default, okay? They don't have to do anything. A church or religious organization, a synagogue, a temple, a mosque, whatever it is, by default, they become tax exempt. They don't actually have to file anything.
Also, they don't have to file a form at the end of the year like the nonprofits
No,
do.
they don't even have to file a form. They're just in existence. They can report it. If they do, that's fine. It's better if they do, but technically they don't even have to report it. They're just a church. So they're the ultimate exception. They've been in business longer than the IRS, so they got a few perks when the IRS came into existence. So the church was around. The church said, no, you're going to do it my way. IRS said, you got it. So churches are exempt from everything. They are their own body. That's the one thing that, death and taxes and churches. They are exempt from taxes. The only thing that's bad is if they are observed doing something where it's obvious that they have violated it, where they're actually profiting from the church, and somebody reports them to the IRS as being profiting from the church. Oh, it's bad. Because the IRS then can come in and investigate them, that they are in violation of their exempt status, that they are attempting to use the church as a cover. And trust me, that has happened. I mean, think about it. You've got an organization there that just got told, you are tax exempt. You have no taxes and no reporting you have to do. I mean, for organized crime, that's like a dream come true. So you can try to run money through it. Form a church that's run by Guido, and run cash through it. So if the IRS discovers that you're not actually running a church, that you're actually running money through it, they will come after you. Okay. So it's better if you do report it, because churches can report the 990 at the end of the year. They do not have to, but it's better if they do, because it shows their profit and loss. If at the very least, all churches should keep a record of all of their income and expenses. I know that's a little bit, people are like, well, it's a church, you're giving money in, it's giving money out, how much can you record? You should, show your expenses as to what donations were made, what donations were made out. Okay. So at the end of the day, you can kind of show where the money was in case anyone asks. And actually, here's an important part. What did I say to the members of the congregation are considered in the eyes of the IRS?
Stockholders?
There you go. They're all the shareholders. What can a shareholder do? As in the eyes of the IRS, what can a shareholder do?
Shareholder can vote they can
vote.
receive
You can also do one other
dividends.
thing. They can do one other thing that's kind of out of the ordinary, but remember, they can request it because they have what? I'm a shareholder of a company. Let's put it in corporate terms. I'm the shareholder of a company. What can I go to that company and say I want to see?
You want to
Right.
see their books?
Right.
Aha! That was Sheila.
Yeah.
I love you. That was great. They want to see their books. I'm a member of a congregation of a church, so in the eyes of the law, in the eyes of the IRS, what am I? I am a shareholder of that church, including all of its funds. So what can I request to see?
The books.
Very good. I can request to see the books of the church because I am now, if honest to God, if you go to the Vatican and try to ask and say you want to see the books of the church, good luck with that. But but in all honesty, if you go to most little churches and the ones that are at least trying to keep some books, and they're probably going to say, okay, here, especially if you're a regular member of the church or whatever, you go, I really would like to see what the books are. And sometimes they usually have regular reports that they give out, here's where our funds are going and whatever. And you can see it. Okay. That is the kind of bookkeeping that just up to that point is what a church needs to keep, is what a church should keep, is saying, here's what we brought in and here's what went out and here's what it went from. We don't necessarily have to say all the details of these were the cash donations and these were the donations we received from so-and-so and so-and-so and so-and-so, because a lot of people actually don't want their name out there like that. They like donations. A lot of people would like their donations to be anonymous. So they just are like, they will get a letter. We do, like our church gives out a letter at the end of the year for taxes, just saying we received this much, thank you, and that sort of thing. You can use this as your receipt for your for donation purposes, and we actually send that out to the members of the church who've paid with checks and that sort of thing, so we can track who those are. Or if they put it in the envelope with their name on the envelope, we do track that, but that's just our church does that only so we can give it to them at the end of the year. Bookkeeping wise, we just keep track of everything that comes into the church and everything that just goes out. We have receipts. We have bookkeeping for a church is pretty much the equivalent to what a person should basically do as bookkeeping. Okay, everything we brought in, everything that went out.
It's more complicated than that, especially with payroll.
Right. It gets more complicated when we add payroll, but because people as an individual, you can have 1099 expenses, you can have all that, you can have rental properties, you can have all that, just like a church can too. But it's keep reasonable books, and if you're a charity, a nonprofit charity, you really actually do need to keep those books, because then at the end of the year you do have to file a 990, okay, to report where all the funds came in and where they went. All right, it's not too hard, guys. I know you can do it. I know you can do it. I've heard you do it. You guys were doing it when we were doing our circles. You knew what the circles were. You understood the exemptions. You knew about the liabilities. So I know you guys can do this. Okay. You guys know more about business now than most people alive. So you guys, I know you guys can do this stuff. All right.
Okay.
So questions. What questions do we have today? I know we did a lot, and actually we ran over by 41 minutes, and I apologize for that, but I know it was a lot. So, questions? We covered basically 5, actually 6, if we count the exempt, the nonprofits. We covered 6 different types of businesses because the nonprofits I really don't put in the business category. So we covered 6 different business types, guys. So I know there's some kind of questions out there. What do we got? All right, from my side, how does the owner of Goodwill get paid?
Through
The salary.
Salary. Why is that?
Because you can't take money out of the organization because it's a nonprofit.
There you go. Very good. So with the LLP, Limited Liability Partnership, okay, what types of organizations can be in an LLP, and why would they want to be?
Professionals.
There you go. So attorneys, CPAs, things like that, doctors. And why do they want to? So they can share the common areas.
Yeah.
Share the common areas, but the liability for each individual just lies with that individual.
And they're not liable for their partner's misdeeds or
There you go.
or malpractice.
Did you hear Garrett?
Good job, Garrett.
That was awesome. That was great. Okay. What happens when the Columbia freezes over and all the apple trees and all that have a really bad season?
It's a silver frost.
It's a silver thaw. And what happens to the farmers?
Crops are severely
Toasted.
damaged.
Very good. And what do they get as a result?
Subsidy.
There you go. Thank you. That was number 2. Again, Garrett, 2 for 2, man. Keep going there. And Sheila, you got the silver thaw, so that was good.
Right.
Very good. Did you hear that? All right. So now, why is the government so concerned about farmers and fishermen versus small businesses?
Because everybody needs to eat.
Aha. Sheila, yes, thank you.
Yes.
Because it affects their bellies. Okay, that's perfect. Because it's actually considered a need. It's something that they can't just blow off. It's something that they really have to pay attention to. Okay, so married couples. Okay, the wife's got a craft store. The husband helps her out with it some of the time. She does about 80% of the work. He does about 20% of the work. What is that?
Qualified joint venture.
Very good. It's really a married
Partnership.
And how do they divide it up?
Based off of their activity and interest in it.
And that was important. That was the best word, Garrett. Their activity. It has to be their actual material activity. In other words, it's not just saying, well, he put in $50 into this and then went and watched the Bears game.
Bears.
The Bears. He went and instead, he actually participated in it, helped build the crafts, helped do something to it. He only had, 20% of the time. She had 80% of the time. So where does that go on their tax return?
Schedule C.
Yes, that's one of the 2.
NSE.
Yes, that's number 2. Listen to you guys, man. I'm so proud of you. All right.
On their joint 1040.
Very good. It had to be a joint 1040. Oh, man, you guys are kicking butt, man. Oh, my God. That is so awesome. So now I have an architecture firm, an engineering firm. What am I going to form? Maybe.
Personal service corporations.
Yes, and what's important about it?
Tax at a flat rate of 35%.
Now, I'm going to give you one more.
Sorry.
Way to go, Naomi.
Owned by the employees.
Owned by the employees. There you go. Now, that is going away, though. The flat rate is going away, but I'm not going to throw that out there too much. Okay. Now, here's the big one, and it's the most complicated one. Who can be in an LLC?
Anyone can open an LLC.
Yes, anyone can open an LLC. Now, why is that different than we were talking about, like the limited liability partnership or the married couple? You know, they're all restricted, aren't they?
They are.
Yeah. Anybody can open an LLC.
They gotta apply for an EIN and be active in some sort of business activity to do it. Though.
Yep. Now, how can it be? What kind of business entity can
Any
it be?
kind.
There you go. It can be a
Landscaping
sole
business.
proprietorship if it's a sole owner.
Yep.
By default, it's what if it's two?
Partnership.
There you go. That's two. Look at that. I heard both of them out there. All right. And if it's more, it can even be what? If you file the form 8832, you can even make it a what?
Corporation.
There you go. It's an election to be a corporation. And it will have what benefits? Even though it's a corporation, it will look like what?
It will look like a C Corp.
S Corp.
It'll look like
S-corp.
a S Corp, and it'll have all the benefits of a partnership.
Yes.
There you go. So that's awesome. So who's liable? Who's liable for the debts of an LLC?
The entity.
The entity.
Thank you. She named it. The entity, not the personal people. That's why it's so cool. It's the entity's liable for it. They're partners. They get all the benefits, but the entity's liable for it. I don't care what goes on. The entity's, you know. And what must an LLC file?
Well, LLC has to have an EIN.
Has to have an EIN. But I mean, let me put it. It's treated as if it's treated as a partnership, basically.
1065.
Thank you. That's what I was trying to get to. And who must sign it?
One of the general partners.
Thank you. Listen to this guy. Oh my God, you guys are awesome. Now, the owners of an LLC avoid what? Because it's like a partnership and like it's an S Corp.
Tax pass-through.
Double taxation.
Double taxation. Oh, man, you guys are getting so good. Oh, man. So that is awesome. Did I just hear all that? That is great. I mean, I could not believe it. That is awesome. So if it is a single owner, one owner, what can it be? What type of entity can it be?
It can be a sole proprietorship, or it can be a limited liability corporation.
And it goes entirely under the person's 1040.
Yep.
It's treated just like it's called an LLC, but it's treated just like it's a sole proprietorship, just with an EIN number. All right. Man, you guys are kicking butt. I am so proud of you.
And it has to have the EIN to be the LLC. Otherwise, it's just a sole proprietorship.
Right.
Even though both would file as just a regular 1040 with a Schedule C, right?
There you go. There you go. All right, man. Okay. What form do farmers file?
Schedule F.
Whoa. This is kind of like, I should start having a buzzer, man. That'd be kind of like, that was good, man. We can play Jeopardy now. You guys are doing awesome. Do you hear how fast you're knocking those things out? All right. We are done for the day. Go home. All right. I am so proud of you guys. I'm telling you, you guys have done great. I am very, very happy.